Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
Good morning. Here are your top stories. Bonds again on the back foot as markets weigh the risks of tighter monetary policy. Christine Lagarde insists any adjustment at the ECB will be gradual. DC and Berlin united. President Biden warns the Nord Stream 2 pipeline would be stopped if Russia invades Ukraine, something Moscow has repeatedly denied it plans to do. And arms wide open, SoftBank embraces plans to IPO the chip designer after Nvidia abandons its acquisition.
Tom, let's look at the futures. I have to say these markets keep on getting gyrated, certainly on the bond spectrum. If you look at what investors are trying to do, sure, they're looking at earnings, but they're really trying to understand also what higher interest rates globally means for their portfolio. So there's quite prospect of quite aggressive central bank steps, and it's not really playing out of the markets, but certainly on the bond market. Yeah,
the strategists, the team at JP Morgan saying buy stocks now. These rate hikes are priced in. That is a call from JP Morgan, putting them squarely against the likes of Morgan Stanley, where Mike Wilson has said there is a winter ahead for stocks. So that debate continues as we reassess the monetary policy outlook. Currently, the gains very modest here in the UK and across the European space, just in the first few seconds of Tuesday's trading day. Gains of 0.3% in Spain and the IBEX, 0.2 on the FTSE 100. The German DAX is flat and the CAC 40 is also flat. But this is also a big day for earnings as well. We'll dig into that shortly with the likes of the French lender BNP Paribas and then, of course, the energy giant BP, two sectors that have performed relatively well, of course, year to date. Let's switch it on and see how things are playing across asset as we look ahead to the US. The big data point still, of course, is that CPI print expected to be above 7% on Thursday for the US. The future's currently pointing flat, really, after a bit of a mixed day yesterday. Ended lower, not by a lot, turned lower towards the end of the session stateside. The US 10-year now at 194. When do we break through 2% for the US 10-year? Is that an imminent prospect now? And of course, what is the read across for the equity markets? Brent is at $92 a barrel, down 0.7%. We continue to keep an eye on the geopolitics. We had that headline around Olaf Scholz meeting in DC with Biden, and of course, we had Macron meeting with Vladimir Putin. The dollar index is currently higher by 0.2%. The focus yesterday was all about the yield story, particularly in the periphery. So just want to update this in terms of what's happening. Germany, of course, not on the periphery, but a benchmark for us. The German Bund, the 10-year, currently just up 1 basis point at positive 24. The Spanish 10-year at 110, up 2 basis points in today's session. The Italian 10-year at 1/6 at 3 basis points, and you're gaining less than a basis point over in Greece, 252. After that run up in yields, very strong double digits, particularly in Greece yesterday. Keeping across that, what that means for these countries, the capital accounts, and the debt that's been taken on as they've had to deal with the pandemic. Francine.
Tom, let's also dig deeper into the sectors. Now, we did have earnings, but I have to say, because of the global bond movement, it's a little bit distracting investors focusing on, for example, BP, which is leading some of the energy higher. You can see Staples also on the higher side. Now, if you look at basic resources, they're the biggest gainers, but also, Tom, they're not by huge amounts. So they're gaining some 1% overall in Europe. The biggest losers is, for example, technology, auto parts, construction, and materials. But I want to spend a bit of time talking about tech. I mean, we talk about tech a lot, but now it's an Amazon story. This is an inflation story, Tom, because if Amazon tells us, look, I struggle to retain workers, I'm going to pay them over $300,000 instead of $160,000, that feeds to the central bank's worst nightmares. And you can see that, for example, industrial is a bit of a mixed bag. We are expecting also a lot of earnings in the U.S.
And that wage story is crucial, isn't it? You're seeing that at the top with the likes of Starbucks paying on average about $17 an hour, all the way to the top. The banking executives, of course, having to ramp up pay there to retain talent. Amazon building on that story. In terms of the corporate stories that we're focusing on today, yeah, big earnings from the likes of the energy giants and the French banks as well. So BP you have here on the left of the screen, getting 1% on the back of a solid set of numbers, and of course the cash flow is coming in after a very strong year for that energy provider. We've seen this story repeat itself, and the pledge to return more cash to shareholders. And you're seeing a similar pledge, by the way, by BNP Paribas, but nonetheless the stock is down almost 4%. Revenues coming in a little below certainly many of their competitors stateside, so maybe concern there from investors. And Ocado, we're not getting this pricing yet, but they missed estimates. They've challenged in terms of building out the options, of course, the capacity as that demand has continued for e-commerce, and it was a miss for Ocado. So we'll check back in with that stock shortly. We want to go back to the yield story, and we have a chart, Francine, that explains what's going on. You had, for the 10th session, first time in 10 sessions, the German two-year yield did not end higher. And we had that commentary from Christine Lagarde seemingly softening the edges of the rhetoric that we saw last Thursday and saying that any moves will be gradual. And we talked about the synchronization yesterday. You highlighted this, the need, of course, for the ECB to run off its bond purchases, the APP and the PEP program, before it gets to that rate hike cycle. This is across 10 days. It's the German two-year. And again, for the first time in 10 sessions, the yield did not move higher. But let's see if that holds.
Yeah, I love that chart. Now, it's a simple chart, but to really encapsulate the story that I've been trying to cover for the last 2 days. I also have a morning must-read, Tom, which is by our Marcus Ashworth, which basically says, yeah, the markets are freaking out, but really this goes back to pricing risk, which we haven't done for quite some time because of the accommodative stance coming from the ECB. And then we're getting some great calls on U.S. Treasuries. I know Citi actually expects U.S. yields to soon surpass the psychological level of 2%, and I'm getting a lot of banks on Treasuries. Now, let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Meta has again threatened to pull Facebook and Instagram from Europe if it is unable to keep transferring user data back to the United States. It's among thousands of companies that rely on a transatlantic data deal, which was struck down by the EU Court of Justice in 2020 on data security concerns. Europe and the US have been in negotiations for months to replace the agreement. ECB President Christine Lagarde says any adjustment to monetary policy will be gradual as the debate over the euro region's first rate hike in more than a decade heats up. Lagarde told European lawmakers the central bank would remain data dependent while assessing the medium-term outlook for inflation. She also warned that price growth could turn out faster than expected in the short term. Blackstone is said to be exploring a combination of its European building materials retailer with a similar business owned by CVC Capital Partners. Sources say Blackstone is discussing a possible merger of Building Materials Europe with CVC's Stark Group alongside preparations to list the company. We're told it's seeking to value the business at almost $7 billion in any deal. That's the Bloomberg Business Flash. Tom, Francine.
Much Laura Wright in London. Now let's get straight into the key market drivers with our markets editor, Christina Kina. Also joining us, Eleanor Taylor-Jolidon, co-head of Swiss and Global Equities at UBP. So thank you both for joining us. Christine, wow, what a week when you look at repricing in a lot of the bonds. At what point do European yields repricing actually impact the broader market?
Well, Francine, I think this will really have to be via funding costs, either for companies who are still trying to get funding in this sort of environment, or any corporates who are kind of in the same boat. And, you know, I think the context in the rise in European yields that we've seen so far, it's important to remember that we're not anywhere near the levels that we saw in previous crisis periods, right? 2017, 2018, or 2015, 2016. So it's still a far away from that, but it is the trajectory and the speed of the move is definitely very concerning. And so I think once we start seeing this flowing through to companies and corporates on the ground, and hearing more reports of these particular entities not being able to access funding as easily as they probably had been prior to this move in yields, then that's probably when it really starts to kind of inflict that pain on the real economy.
Eleanor, let's bring you in this point. Good morning. Thank you for joining us this Tuesday. How are you thinking about that question then? The higher rate environment, the lack of liquidity, or at least liquidity being removed by the central banks, and the impact then at the corporate and the equity level?
But as far as equity is concerned, we're actually in rather a good situation. We've been waiting for a market correction of such amplitude for a number of years now. And when we've had market corrections, it's tended to be because there really has been a black swan out there. This time there's no black swan. It's normal that equities do correct a little bit as people consider an interest rate hike. But what we do know and what we can see in previous periods is when we are in an interest rate hiking period, that is actually very favorable for equity, because equity doesn't necessarily react to interest rates so much as to GDP growth. If you've got an interest rate hike at the moment, it's also because we've got that GDP growth which is supportive for equity markets.
I mean, I imagine, Eleanor, it has a huge impact on dividends. Let me ask Christine, what we heard from BP in terms of dividends and whether actually rising bond yields also changes the appetite for some of these dividend stocks.
Yeah, it's a very good question, Francine, because that's certainly something that had long been the appeal of some of the stocks here in Europe, right? It's a very dividend-rich sort of equity market. And you would imagine that something like an increase in dividend yields under more easy accommodation, the sort of circumstances would be very, very attractive. It would be normally a no-brainer for investors to pile into some dividend-yielding stocks. But in this sort of environment, it's certainly posing a challenge to that. I think it still does help the appeal of Europe at the moment. It's just a question of how long they're going to be able to stand that, especially if we're seeing Treasury yields potentially clinching that 2% level not too long now, perhaps even in the first quarter, as some strategists are seeing it.
Christine, we had this in our stocks to watch. It didn't price. Now we've got it. Ocado's down, 7-8% on the back of a miss in earnings. I think this is symbolic of a broader shift as these companies try and readjust post-pandemic. What for you is the highlight from Ocado and how you can read across to broader sectors on this?
Well, Tom, I think it was very interesting that what really held them back was their capacity issues. And I think a lot of this is definitely borne out by the fact that the labor market in the UK is tightening quite a bit. It's definitely a feature of the pandemic era, the Great Resignation, and people wanting to shift jobs. And that labor tightness, of course, contributing to the broader inflation environment, certainly something that could potentially lead to higher wages, something that Governor Andrew Bailey was definitely worried about when he was commenting on this last week in the BOE aftermath. And so I think this is very much a reflection of the shift in just the potential cost pressures in the UK economy at the moment, and the fact that we're seeing a big grocer like Ocado struggling with these capacity issues certainly speaks to where the UK economy is going at the moment.
I mean, I'm the hugest Ocado buyer. Disclaimer, I am the person that actually tries to prop up the share price just because I buy everything on Ocado, but they've seen shortages of drivers.
Yeah.
We've seen shortages of a number of things on the virtual shelves as well. Eleanor, one of the other things is that, we focused a lot on margins in the last earnings mix. How much are you looking at inventories and this wage price inflation for earnings, depending on what company it is or what sector they're in?
I think probably the pandemic is going to change habits as regards inventories, because we have seen the supply chain shocks, and we probably are going to see on the working capital side a higher level of inventory going through in the future for companies. And certainly that's something we're asking companies about at the moment, and we're appreciating the adaptations they're making. We may also see a slightly more diverse supply base where people consider that they cannot go to just a single supply situation, and they may also have to have more nearshoring as far as supply is concerned. That really plays into favour of a number of companies which are suppliers in Europe, as opposed to having to face the competition that they may have been facing in recent years out of Asia.
Okay, Eleanor Taylor-Jolliden from UBP stays with us. We'll get more of your calls after the break. Christina Kino of Bloomberg, of course, crossing all things thematic for us across these markets. Thank you. Fran.
Now, coming up later in the program, we'll talk about inflation wages. We'll be speaking to BlackRock's head of macro research, Elga Bartsch, about her outlook for rates. And a little later, we'll also be joined by the PIMCO senior portfolio manager for emerging markets, Jakov Arnopoulin, on the implications of those moves in the M space. It's really quite amazing, Tom. When you think about inflation, we talk about inflation as if it was a number like that, sometimes in the air. And then you look at Amazon, and they're basically doubling salaries of key people they want to keep. But this is not one or two people. This is across the board.
Yeah, and that is, of course, on the back of paying the warehouse workers and giving them an increase in and during that pandemic. So this is a broad story, and it has that implication for the wage stickiness and the central banks. Okay, stay with us. This is Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to the end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open, everyone. 15 minutes into the European trading day. We're still in full earnings season, but a lot of the focus, of course, on what's happening with bonds. The European stocks are gaining some 0.3%. Sovereign bonds once again skidding, the dollar rising, investors really grappling with the implications of global monetary policy tightening everywhere. Asian stocks were mixed amid a drop in China, and we see this mixed picture also in Europe, Tom.
Yes, and part of the earnings story, of course, BNP Paribas, banks and the banking sector we know are broadly beneficiaries of the higher yield environment. They have promised their shareholders a boost in profitability and returns. The Paris-based bank set a target for a return on tangible equity of more than 11% in 4 years' time. That is up from 10% last year. But fourth quarter equity trading revenue did fall short of analyst expectations. CFO Lars Machinel told Bloomberg rising interest rates bode well for the lender.
If you look at the uncertainty that hangs a bit over, is indeed the interest rates. Yeah, you see different positions unfolding. Intrinsically, we have taken a very conservative stance when we made our objectives in our plan. So if the rates would go up, showing even a faster growth, then of course that will be the cherry on the cake.
That was BNP Paribas CFO Lars Machinel speaking with Bloomberg's Caroline Connor in Paris. Eleanor Taylor-Jollard, co-head of Swiss and Global Equities at UBP, is still with us. Eleanor, the banks and the energy sectors have done pretty well year to date, certainly outperforming many of the other sectors. Do you see still an opportunity here, or has a lot of the optimism been baked in at this point?
It's always a stock picking game. There's probably a little bit too much optimism, which has come through at the beginning of this year. The stocks that you refer to, or the sectors that you refer to, are classic rotation stocks after the strong performer value creation last year, as opposed to the more value areas of the market where you'd find banks and energy stocks. If you look at energy stocks, you've got to remember that with new regulation coming in, and you're going to have to think quite carefully about what the costs for these companies are going to be going forward. You also need to consider what the capital expenditure for these companies is. If you look at banks, they need an interest rate being higher for that to function, but they also need people to want to be active in their investments, and that is still perhaps slightly out.
Yeah, do you see consolidation in the banking sector and elsewhere? And what does it mean for investors trying to catch that falling knife?
As far as consolidation is concerned, we know how difficult it is to be done in the banking sector. So we see a little bit of acquisitions of small technologies, niche areas. I think of the acquisition UBS made earlier on this year in terms of getting a platform for their affluent clients in the United States. But I don't think you're going to see any cross-border major M&A in the banking sector, because we know that that often is not value creative.
Eleanor, you talk about wanting to select companies that have low indebtedness, low dependency on energy and pricing power. Where is that taking you to at this point?
It's more a question of wanting to invest in companies which are truly value creative, because we know those are the ones which are resisting in situations both of higher inflation, because they have the pricing power, because they are able indeed to pass on those higher costs to their customers, because their customers need their products, if you like. And it's also looking at companies which are not overly capital intensive, which takes us back to not needing too high an energy input in order to be productive. And that is really where we continue to see the market moving. We also think we're getting close to peak inflation levels, probably in the next 2 quarters, one or 2 quarters. And that again means that we'll come back to a more fundamental approach of value creation.
Eleanor, let me bring you to my chart of the day, or at least the chart of the hour for me. And this is looking at basically the inflationary environment, helping to extend the outperformance of European oil stocks to more expensive renewable energy peers. Now, I know there's a number of questions on whether you should just be fully invested in ESG just because of the way the world is going. But how do you see this panning out? I know we touched on all with dividends, but are you invested in renewables?
If we look at ESG, it is absolutely the new normal. And certainly what we want to do is to accompany that movement to a more environmentally friendly world. And we do invest in where we see interesting opportunities in the renewable space. However, I think it would be wrong to ignore the traditional energy markets and see how important it is here also to engage with these companies and help them offer a better and more environmentally friendly solution.
Okay, Eleanor Taylor-Jollin, co-head of Swiss and Global Equities at UBP. Thank you. Coming up, going public, again, SoftBank releases earnings and confirms what the market suspected, that it's lining up chip designer ARM for an IPO. We will get the details next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Welcome back to the Open. We are 23 minutes into the European trading day. A little bit more optimism creeping into these markets now. Gains of 0.6% across the benchmark. Sector by sector, top of the list, basic resources. Bottom of the list, technology, down just 0.4%.
Now let's get the latest from the tech sector. Let's start with SoftBank as it plans an IPO for chip designer ARM after NVIDIA abandoned a proposed acquisition in the face of fierce opposition from regulators and customers. Well, joining us now is our Bloomberg anchor, Danny Berger, with the very latest on the tech sector. Danny, I don't know whether the SoftBank or the fact that actually they can't sell off ARM has more to do with a problem for SoftBank or whether it's something that NVIDIA doesn't want to get messed up with.
Right. Well, I guess SoftBank does get something out of it. It gets the $1.25 billion breakup fee, so it's not all bad news for them. But in some ways, it really was a story that ARM being owned by SoftBank was seen as a good thing in the industry because they could retain neutrality. All of a sudden, if ARM is getting sold to what some of the licensees would consider a competitor, that would be bad news. And so regulators complained, the licensees complained. It did seem that this was destined to fail. But of course, this is a really monumentous IPO. ARM technology is in everything. It's in iPhones. It's in tiny little kitchen appliances, some very advanced technology, which I'm sure you can teach us all about, Francine. But yeah, this is going to be a really momentous IPO.
Yeah, it's a UK success story, this company, longer term, based in Cambridge, of course. But they weren't able to make that case, were they, NVIDIA, that, look, we're going to continue to be neutral. Amazon doubling. We've been talking about this. Francine loves this story. Amazon doubling the base salary for
to over 300,000.
Yes, 360,000. So they are saying, okay, across the board, we're looking at a wide range of changing salaries. Of course, this is on the high end, the highest base you could get. One thing I would note, not to kind of dampen this, excitement about a higher pay rise, Amazon had really used stock rewards as an option for their employees to say, okay, we're going to pay you via stock. You look at what the stock has done, that's less attractive. And there have been lots of media reports that Amazon is reaching crisis level of employee exits. 50 VPs have departed in the last year. So, I mean, look, if stock's not as attractive, you got to up the base.
Yeah, so, I mean, this, of course, is not necessarily all about inflationary pressures, but it also goes to the fact that a lot of big companies are just struggling to retain talent. And then we have Mr. Thiel leaving Meta to take care of Trump.
Exactly. Can I also just say, so Zuckerberg and Thiel, their partnership goes way back. They're first introduced by Sean Parker, and I literally can't think of Sean Parker without thinking about Justin Timberlake, because he was the Napster founder and in the social network Justin Timberlake played him.
I have that image in the canteen where they're sitting down and saying, I want to make $1 million. They're like, no, $1 billion, think billion.
Yeah, so perhaps the biggest aside I could possibly make when talking about this story, but it just go to show they have a really long relationship. He's been advising Zuckerberg for 2 decades, but the concern is that the politics becomes a distraction for Facebook. Thiel has long been involved in Trump's politics and conservative politics. He wants to go and back people for U.S. Senate. If he does that while on Facebook's board, could be a distraction.
Yeah,
Danny Berger.
No, I was going to say, we'll see what happens to the social media network that Trump wants to create.
Yeah, this could get a boost from Peter Thiel. Stay with us, Danny Berger, of course, with the latest on the tech story. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into European trading day, and here are your top stories. Bonds again on the back foot as markets weigh the risks of tighter monetary policy. Christine Lagarde insists that any adjustment at the ECB will be gradual. DC and Berlin united. President Biden warns the Nord Stream 2 pipeline would be stopped if Russia invades Ukraine, something Moscow has repeatedly denied it plans to do. And arms wide open, will SoftBank embrace its plans to IPO as a chip designer after NVIDIA abandons its acquisition? Tom, it's all playing out in the markets. We have quite a lot of earnings, but actually everyone really distracted with these big bond moves.
Yeah, I think to some extent, having just checked the yields, the bond move story is less pertinent today than it was yesterday. The shift really focusing on the focus shifting, I should say, to the earnings story to some extent. But of course, we keep an eye on those peripheral bonds in particular after those significant double-digit moves that we saw, particularly around Greece and Greek yields yesterday. But less volatile, certainly in the first few hours of this morning. That could, of course, all change. But markets continuing to adjust to the monetary policy reality, of course. But the earnings picture, BNP Paribas, BP, Ocado, all playing into the mix here. When you look at the FTSE 100, for example, gaining 0.7%. BP is part of the mix there, gaining almost 2%, a solid set of results, and then a pledge to return more cash to shareholders. Ocado, on the flip side, disappointing investors, missing estimates and challenges around meeting that capacity. Across the benchmark, you're seeing gains of 0.7. The optimism has started to eke into these markets now after uncertainty at the open. Certainly, we're just 30 minutes in, and you closed lower stateside, but it seems that there is a bit of a cause for optimism, particularly around these earnings. The DAX is currently gaining 0.7% as well. Olaf Scholz was in DC meeting with President Biden, seeming to commit to cancelling Nord Stream 2 if Russia does indeed invade Ukraine, which Moscow says it will not and has no plans to do. Basic resources gaining 2%. BP is part of that. Chemicals also up more than 1%. Autos and parts also in positive territory. Sector, every single sector in the green. Apart from technology, down 0.4%. That is the picture 30 minutes into the trading session. Francine.
Now, this is what we're looking at. So when you look at credit spreads, and of course, the credit market now showing signs of stress, which is one of the things that we're watching about the most. I know, Tom, there's a great chart looking at that. Yeah. And it's there. It's basically really just looking at the stress level that they saw back in December 2020 compared to now. So as you have rising yields, even corporate bonds and high yields are being impacted, and that could have a repricing for the broader market.
We are starting to see exactly that. Credit stress, a little bit around the edges. We shouldn't get too concerned, according to some. within these markets, but you're starting to see that reaction function now. And what the difference is when you compare back to, for example, October, November, this is last year, when you saw those spreads actually tighten as yields started to rise on the sovereigns. That is now not playing out, as you were saying. So the white line is what we're seeing in terms of the US 10-year yield, and then, of course, that credit yield that is widening at the same time. So that will be a concern, and what it means around the health of these corporates as these credit spreads start to widen, whether this continues within this fashion, Francine.
Yes, such a great chart, and something that Cormac Mullen was also talking about as being a potential canary in the coal mine. Now, sovereign bonds extending declines today with the 10-year Treasury yield approaching 2%. That's as investors grapple with policy tightening from central banks around the world. Now, let's take a look at this chart, which shows the major moves we've seen in the German 2-year yield as the debate over the region's first rate hike in more than a decade heats up. The ECB President Christine Lagarde spoke at the EU Parliament yesterday.
A rate hike will not occur before our net asset purchases finish. Moreover, there are 3 conditions that will have to be satisfied before the Governing Council feels sufficiently confident that a tilt in our policy rate is appropriate. All the 3 conditions are meant as safeguards against a premature increase in interest rates. Finally, any adjustment to our policy will be gradual.
Well, joining us now is Elga Bartsch, BlackRock Head of Macro Research. And Elga, thank you so much for joining us. We want to look longer term at some of your great research done by yourselves and the team about what it means for policy tightening. But first of all, what are you expecting the ECB to do? There were some pretty violent moves when it comes to yields in the last couple of days. Is the market misunderstanding the main point that Christine Lagarde is trying to make?
I do think that markets have gotten ahead of what is likely to happen. What the ECB has communicated is that it might taper faster than planned so far, will end net asset purchases that could happen in the second half of this year, and then start to raise interest rates. But the fact that normalization starts does not tell us much about where it ends, and we continue to think that in Europe, but also globally, central banks will hike a lot less than they have done historically and a lot less than what current inflation pressures would suggest.
What is the concern? How vulnerable are the peripherals at this point?
Well, as you can see, the market really sort of had a wake-up call, thinking that QE could end pretty quickly. That said, I think already in December, the ECB announced the end of the PEP program. It announced that it will eventually bring down the APP to just 20 billion euros per month, which against the net funding requirements of larger peripheral countries is a very small amount. So to some extent, I think the surprise hawkish pivot last week just drove the message home that the ECB is not going to be there to the same extent that it has been in the past.
Elga, I know that actually your longer term outlook still, is supposed on the fact that inflation is definitely supply driven rather than excess demand. But what's the sequencing that we could see from the ECB?
So in terms of the European situation, and I think we've heard that from Christine Lagarde both last week and again yesterday, it's important to distinguish also versus the situation in the US. In Europe, it's really the supply side issues, especially on the energy side, that are much more pressing than strong demand, say, fueled by fiscal policy. We also, in Europe, see so far very muted wage increases, and we still have inflation expectations that are anchored below the ECB's inflation target. So all of that sort of is different, an important difference with the US. So that means that the ECB is likely looking at a situation where inflation is zooming in on its inflation target. If and when exactly that approach is going to materialize, it's very difficult to assess because there are lots of
pandemic effects, energy effects, geopolitical stresses that play a role. But crucially, the fact that supply side effects dominate really are a game changer on the question of how central banks should react to this. It is a material difference if inflation phenomena are primarily driven by supply side shifts.
When it comes to the credit markets, is there a certain resilience then? If your broader view is that the markets are pricing in too much hawkishness, too many hikes, too much tightening at this point, particularly from the ECB, is the stress that we started to see around the credit markets, is that something that we can overlook?
I wouldn't overlook it necessarily, but I think it's important to look through some of the near-term volatility and keep a longer-term perspective, because what I think is likely is that the market are overpricing the total amount of interest rate hikes that we're likely to see in coming years. But what also I think is clear is that the ECB will not only dial back, but also end its net asset purchases in the course of this year, and then we'll just have to work with what it has to reinvest, including the PEP program, which allows some more flexibility than some of the other programs.
Elga, is that also true of the US? What are you expecting from the Fed? Are they now behind the curve and therefore have to be much more aggressive in their tightening?
Well, the situation, the macroeconomic backdrop in the US is different because there are much more sizable excess savings. We have a labor market that is running a lot hotter than the European one. And as a result, it looks very likely that the Federal Reserve is keen to kick off its rate hike cycle sooner rather than later, and will likely move much more quickly than previously anticipated and then in previous normalization phases towards quantitative tightening, i.e. rolling off its balance sheet.
And if they have that in the background, as Jay Powell has suggested, is the liquidity situation going to be benign enough for global markets, or is there a shock in the making there?
So we need to see how markets are reacting to when central banks are starting to dial down their balance sheets, in particular in the US. And we have seen on occasions that in particular when there was major news to process and large trading volumes, that at least on a very short-term basis, that some stresses emerged in some of the larger government bond markets. So I don't think that necessarily you have a sustained liquidity squeeze, but liquidity might become less ample than it has been historically because of the balance sheet policies of various central banks.
Elga, do you think the U.S. 10-year yield could actually test 3% this year?
Well, I'm not sure about that specific number, but I think we sort of have been warning in our global outlook that we would stay underweight government bonds in general and U.S. Treasuries in particular, because we feel that fixed income markets might have another down year in 2022.
Okay, stay underweight those government bonds, particularly in the US. The markets may be getting ahead of their skis when it comes to pricing and tightening from the ECB. Elga Barch, thank you as ever for those insights. BlackRock head of macro research.
Now, coming up, the shuttle diplomacy continues as efforts to avert tensions over Ukraine look for a breakthrough. I think talks between Vladimir Putin and Emmanuel Macron were late into the night. Apparently, they also had a 6-course meal, but actually no breakthrough. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Welcome back to the Open, everyone. 45 minutes into the European trading day. We must look at European stocks. We do have quite a lot of earnings, gaining some sense of 8%. But actually, all of the action is, as we saw in the last 2 days, definitely in the bond market with the U.S. Treasury. Look, there's more and more calls, actually, from banks that this would surpass 2% quite quickly. We also have a 3% call for U.S. 10-year. And investors, in general, just trying to grapple with the implications of global monetary policy tightening and what it means for the broader markets, Tom.
And layering on top of that, the geopolitical story of the moment, of course, and we know that US President Biden says the controversial Nord Stream 2 gas pipeline between Russia and Germany would be stopped. He was pretty clear about this if Moscow invades Ukraine, a plan which Russia has denied. For more, we are joined by European correspondent Maria Tadeo in Brussels. Maria, these comments came with Olaf Scholz in DC, standing beside Biden. He didn't push back. What was your takeaway from how much has been achieved?
Well, Tom, the point here, of course, is that this was a diplomatic trip to change perceptions around Germany. We know that the German diplomatic body has been under huge pressure for the past 2-3 weeks, and they're often accused of being soft on Russia. Now, Olaf Scholz had a clear message yesterday. He spoke in English. He also did an interview with a major network, Primetime TV, to make it clear that Germany is a reliable partner, that Germany is working to avoid a war, is working closely with the United States, and stands behind NATO. Now, on the Nord Stream 2 pipeline, that seems to be the point of tension. The president was very clear, saying one way or another there would be no Nord Stream pipeline if Russia were to invade Ukraine. Now, Olaf Scholz was not that clear. He remains in that ambiguity. But the reality is, Tom, when we ask the Germans, would you ditch it? This is not a yes or no answer for them. This is a very complex question. If Germany were to ditch this thing, which, by the way, is huge, and it's already built under Angela Merkel, it means litigation. It probably means German taxpayer money paying for this. So this is not just a yes or no way, the way they see it, but they did make a very clear commitment saying we have been paying also, by the way, support, financial support for Ukraine, and we will continue to do this.
All right, Maria, thank you so much. Yeah, geopolitics is rarely yes or no. And then we had that epic meeting, I think 6 hours, and then a 6-course meal with Vladimir Putin and Emmanuel Macron, even more socially distanced than we are, Tom. There's like this massive, it was a grand room. I think we're going to put up the picture, I hope. I put it on social media.
It's so they couldn't play footsie, apparently. That was always the danger.
That's how close they are.
A 10-meter gap, and it's a grand white table, and they're kind of looking sternly across each other.
I know, as gold as the Elysee, so at least it makes Macron feel at home. Now, Jakov Arnopol is here to talk about what it means for emerging markets. He's PIMCO Emerging Market Portfolio Manager. Jakov, as always, thank you so much for coming on. I have a million questions, actually, simply about a possible invasion of Ukraine. I don't know how the market would react to it. We've seen, skirmishes in terms of market reaction at the margin, but, if tomorrow there's an invasion, what do the markets do?
Sure. Well, once again, thanks for having me. Great to be in the studio. Look, I think
first and foremost, we're all hoping for a peaceful resolution.
Of course.
And I think the last thing the world needs right now is another war. So very much, praying for that. I think with regards to market reaction, what we've witnessed is that since the events of 2014, both countries on the sides of this conflict, Ukraine and Russia, have built up significant buffers. When we look at their reserves, they've grown significantly. For Ukraine, it's $30 billion. That's 15% of their GDP. For Russia, it's $630 billion. That's 30% of their GDP. So realistically, the buffers are stronger. Right. They can withstand significant shocks, significant volatility. So I think on the back of that, the economies will suffer less. Again, we're hoping nothing happens. Another important trend to observe is just how much Russia, for example, has insulated its economy since 2014, 2015. There's been this focus inwards and a shift from trade with the West to trade with the East.
Yeah.
When we've been looking at the ruble, it's repriced a little bit of strength of the ruble as an indicator. What are you looking at in terms of the pricing? What is your sense of the market pricing around this issue, and whether or not indeed there is an opportunity potentially within credit, within sovereigns, as a result of these tensions?
As usual in such cases, it's difficult to disentangle what is geopolitics and what is valuations, right? From an economic standpoint, if you look at Russia, again, a robust balance sheet, as we were saying, pretty strong growth, and look at oil prices, an interesting nugget is that oil prices in rubles have never been higher. Yeah. So realistically, they're on a very strong footing. So if we were to remove the geopolitical tensions, the currency certainly has room to strengthen. But there's also obviously this overhang, this cross-current of uncertainty around events between Russia and Ukraine.
So, Jakub, what does it mean for your portfolio actually selling off, for example, assets in neighboring countries to Ukraine? So, is it Central Europe that should be sold off?
I'd be reluctant to be as alarmist here, simply because we do see, in the immediate neighborhood, some of the CIS countries are actually quite robust, and certainly Eastern Europe. We do favor a country like Serbia, like Romania. They're further removed from the conflict. We've seen quite a meaningful repricing already that to us is not justified, and solid balance sheets. So we do find opportunities in value and fixed income of those two countries.
You touched on commodities, the question, of course, of Russia and the importance of the oil sector there. But more broadly, you're pointing to the fact that a number of commodity-producing countries haven't benefited as much as we might expect from these very, very high prices. What is behind that disconnect? Does that continue?
Absolutely. That's certainly been a trend in the past few months, a surprising trend in emerging markets, because typically we see a much greater correlation between oil prices, nat gas prices, and emerging market commodity producers. But I think some of this underperformance, the lag, is probably due to the other cross currents EM is facing. We're in this classic Fed hiking cycle. We typically see an initial EM underperformance. I think on the back of that, there's been some reluctance by investors to get as involved in emerging markets as we would expect. And on the back of that, valuations have cheapened meaningfully. So when I think of the commodity producers that have lagged in the rally, Nigeria comes to mind, obviously big oil play. But some of the less known, maybe kind of smaller commodity areas, it's something like fertilizer producers in Morocco, right? Maybe a little bit off the beaten track, but also quite interesting given the spike in fertilizer prices.
Jakub, what's your take on actually Asian debts? Are you lukewarm on Asian debt? Because in the hiking cycle, they could be the last ones to hike.
It's curious because there is certainly one area that people look at a lot is China. Yeah. And Chinese government bonds, the famous CGBs, have been quite resilient as of late, given that unlike other EM central banks, China has been easing of late. PBOC has been quite dovish. People's Bank of China. We expect the dovishness will continue. So, we understand the resilience may be justified there. But I think having said that, when we talk about China, unlike our typical Western reaction function of looking at central banks, much more important than monetary policy is really what's happening on the credit side. And there are certain events in the near future, specifically the March NPC, National People's Congress, which will determine some of the other stimulus we may see coming out of China. Very material for markets, very material for inflation as well.
What are the opportunities in investment grade at this point, Jakub?
Well, it's great you mentioned that, because I think there is a couple of angles here. One is one of the headwinds, one of the cross currents for EM has been a concern about downgrades. And specifically countries like Romania, countries like Panama have underperformed, have lagged, because people have worried about them losing their IG status and going to high yield. as we look at both balance sheets, as we speak to rating agencies, we're fairly constructive on both names. So I think those are interesting names to focus on. Plus, on a relative basis, and that's the second angle I mentioned, compared to some of the opportunities in developed markets in Europe and the US, EM has certainly underperformed a lot. So that the valuation gap has opened up quite a lot.
Yakov, thanks so much. Yakov Arnopolin there, PIMCO Emerging Markets Portfolio Manager. We're going to take him out for dinner and actually have this like socially distanced table, a little bit like Emmanuel Macron, Vladimir Putin. We have the photo. I'm absolutely obsessed with it. I mean, what a picture. So it didn't go to plan because they didn't have any breakthrough, but at least, they reiterated their position and they had a 6-course meal. We'll have plenty more.
Wide-angle photography.
Wide-angle photography. We'll have plenty more on bonds. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Open. European equities just holding on to their gains, 0.7%. Basic Resources charging out of the gate, up almost 3%. Future stateside pointing to gains of 0.2%. And in terms of your yield space, a bit of the heat coming off the run-up in yields that we saw yesterday. Yields in the Greek and Italian down a couple of basis points. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
If Russia invades, there will be no longer a Nord Stream 2.
Any adjustment to our policy will be gradual.
I've been doing this 30 years, and I've never seen markets like this.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Christine Lagarde insists any adjustment at the ECB will be gradual. Bonds again on the back foot. Markets weigh the risk of tighter monetary policy. D.C. and Berlin united. President Biden warns the Nord Stream 2 pipeline would be stopped if Russia invades Ukraine. And stay with Bloomberg Surveillance Early Edition this hour. Music mogul Merck Mercuriadis joins us. We discuss Spotify, tonight's Brit Awards, and of course the industry as a whole as we see higher returns. Send in your questions on IB plus TV Go. Now, first thing is first, let's check into the markets and of course a repricing of bonds, also broadening to the bigger market. I think the story is of course on the German 2-year yield with what we've seen in the last week, but really it's all playing out in the U.S. 10-year yield. Now, I'm looking at a lot of bank calls, including, for example, Citigroup expecting U.S. yields to soon touch 2%. We have a couple of calls also at 3%. We had a fantastic interview with Elga Barge of BlackRock, an insider at the ECB in the previous life, really telling us about the dynamics and differential between what we're seeing from Germany and what we're seeing from the U.S. Now, that German 10-year yields actually, or 2-year yield, 10 days actually have risen, and that could mean a little bit more pressure on the ECB to try and not widen those spreads. European stocks, again, distracted by what's happening in bonds, but they're also looking at earnings, gaining some 0.6%. Now, it is also a story of differential. We had a fantastic interview with our Jeff Curry of Goldman Sachs, and crude oil, the one to watch out for, because when this gets to 100, a lot of the companies that are in the oil space will benefit, but it could put a lot of pressure on some of the politics, including BP today coming out with more dividends. If you look at the difference between what renewables are giving shareholders and oil companies, it's one to watch out for, which may not be the way that climate change watchers want it to go. And then the CAC 40 and the FTSE MIB gaining between 0.7% and 1%. But the story, again, is one of divergence, especially in bonds, between Germany, Italy, Germany, and Greece. Now, the ECB president, Christine Lagarde, has said any adjustment to monetary policy will be gradual as the debate over the euro region's first interest rate hike in more than a decade heats up.
A rate hike will not occur before our net asset purchases finish. Moreover, there are 3 conditions that will have to be satisfied before the Governing Council feels sufficiently confident that a tilt in our policy rate is appropriate. All the three conditions are meant as safeguards against a premature increase in interest rates. Finally, any adjustment to our policy will be gradual.
Well, we're now joined by Patrick Armstrong, Chief Investment Officer of Plurimi Wealth, in the studio. Big day for us. And Bloomberg's Christina Aquino, our markets editor. Christine, let's kick off with you. When you look at European yields and some of the moves that we saw there, at what point does it start, inflicting pain on riskier assets in Europe?
Well, Francine, I in particular am watching out for those funding costs for corporates on the ground. And I think that's really where you would want to look for signs of pain at the onset. It's one thing, I think, for yields to be moving in this direction and at this pace, and it's another for just the real economy impact of it via corporates not being able to access the funding that they would want in this sort of environment. I think that really is when it starts to bite for folks on the ground, and really an indication of these financial conditions starting to really tighten as the ECB and other central banks head into tighter policy.
Let's also bring in, of course, Patrick Armstrong. Patrick, I want to talk about my morning must-read, and this is from Bloomberg Opinion's Marcus Ashworth. He wrote a piece called "The World Gets Back to the Right Side of Zero," and he says, "I have long argued against the folly of inverting the time value of money. It's unnatural," he says. "Madness lies as being incentivized to borrow. We spend more than we earn, and our children and their children will be saddled with paying all back of it." So is the premise actually of interest rates moving a good thing longer term? So a bit of pain for bond traders now, but it's all for the best.
I think you have to get back to zero to have any sense of normalcy. We've had extreme measures that were needed with the pandemic. We've had a crisis situation in the economy. We had negative interest rates even before that. Getting to zero is still a very accommodative policy in any textbook you read. I don't think any chief financial officer is going to change capital expenditure plans when interest rates go from negative to zero.
Right, but what happens, for example, in U.S. Treasury? So if we have 3% this year, and I know it's a big if, but we could, what does it mean for portfolios?
I think it's a duration call. So we're short treasuries. We're short the most extreme growth companies, the companies that don't have earnings yet, where you really have to discount future cash flows and have grandiose assumptions about what kind of market share they'll get over the next decade. Those kind of companies are at risk. Companies that are producing cash flow today, that are paying dividend yields, those kind of companies are already trading at multiples that are 10 to 12, a lot of them, and that's normal. So if you get to a normal interest rate, normal valuations, I don't think should be impaired.
And Christine, this goes back to one of your main takeaways for BP, which is actually dividends are back. But if you put that in context with rising yields, what does it mean for these big oil majors?
Yeah, it's definitely going to be a bit more of a challenge, Francine, because, the appeal of these dividend yielding stocks back when yields were super, super low is that comparative yield that they offer. And now that's a little bit less of a selling point, given that yields are where they are. And so I think it's a matter of, making those dividends attractive enough that investors stay enticed to these types of stocks, even despite the higher yield environment that we're seeing.
So is that how you choose companies? Dividend rich?
And also share buybacks. It's another form of yield, so that's what American companies have been doing so successfully. So I think look at the actual yield, but if they're buying back shares, that's a very powerful tailwind for equity investors as well.
So I have a great chart, actually, which I kind of made for you in mind, and it's looking at high yield, because I know you've liked it in the past, and Valerie helped me put this together. I don't know if we have it, because I'm a little bit late in calling it, but basically it shows the credit market now showing signs of stress, raising the chances of a disorderly play out in yields, piling further pressure on global risk assets. Do you still like anything in the high yield space?
I still prefer high yield because it comes with a shorter duration just naturally. They're generally issued with shorter durations. They have a higher yield, so that pulls the duration down as well. We're still in a phase where the economy is growing faster than potential in all regions. So I don't think we're in an environment where I expect defaults. I think central banks will be hiking. That'll put some pressures on these higher yielding companies, but I still prefer high yield to a Bund or a Treasury.
Yeah, very quickly, European bank earnings, a little bit mixed today, actually, Christine.
Yeah, absolutely, Francine. And I think it really is a question of, is it too early for them to start benefiting from this higher yield, higher interest rate environment, given that we haven't actually seen these rate hikes yet? So perhaps 4Q might not be the place to be looking for those benefits just yet, perhaps a little bit later, maybe this year into 1Q or the second quarter.
Yeah, do you own any banks?
We have Citibank in America. We don't have any European banks. I'm going to wait until I sense a steepening of the curve. So we're at the point where curve's still inverting. Steepening will lead to some interest rate margin.
Okay, so we're what, a couple of weeks away from that, given things, the way things are going, Patrick?
Well, I'm short bonds, I'm short treasury, so I do expect a steepening, but I want to see it happen rather than expect it to happen.
Okay, buy into it. Thank you both. Bloomberg's Trina Kino looking at the markets, and Patrick Armstrong, Chief Investment Officer of Plurimi Wealth, stays with us. I know he has a couple of thoughts also on tech. Coming up, we speak to the Hypnosis founder and chief executive, Mercuriadis, at around 9:30 a.m. London time. This is really a conversation about the music industry and some of the returns that we've seen there. They've been buying huge catalogs from famous artists, but what does that mean when inflation is rising? Stay tuned for that interview. You can send in your questions on IB Plus TV Go. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I've been doing this 30 years and I've never seen markets like this. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alley, you name it, we're out of it.
Jeff Curry on roaring form, the Goldman Sachs Global Head of Commodities Research, talking about price surges. More from him on the latest on energy, commodities, and markets. Check out The Price of Power on Bloomberg.com and YouTube. Now, SoftBank plans to take UK chip designer Arm public after it proposed a $66 billion sale of the business to NVIDIA, and that collapsed after regulators expressed competition concerns. With us to unpack all of this is Bloomberg's tech reporter, Ivan Livingstone. And then we go, of course, to Patrick Armstrong to look at whether he's scooping up some of these technology stocks. So, Ivan, thanks so much for joining us. SoftBank confirmed that what the market's expected. So what's next for Arm?
Well, there's a lot next for Arm, Francine. You know, the company now has to prepare for its IPO. That's looking like it'll come kind of in the next year or so. There's also a change of leadership at the top of the firm. And, you know, this key player in the global semiconductor industry, they need to repair some of their relationships with their customers and also focus on their position in China.
So I'm also quite obsessed with this Facebook story, Meta, because yesterday they kind of, you know, hurt, or the EU saying, look, if you don't go by our rules, then we're just going to pull out of Europe. I mean, it doesn't really make sense for them from a strategic but also revenue point of view.
Yeah, it's hard to believe that Facebook, Meta actually pulls out of Europe. There's this wrangling over where the company's data is stored, and we've seen data localization issues play out before. So there's negotiations between the EU and the US, and if I had to guess, this will end in some sort of compromise, and I'll still be able to use Instagram in London. Yeah.
I know everyone in the newsroom was like, wait, are we still going to be using WhatsApp and things like that? Amazon, so Amazon is paying their workers a lot more, and that feeds to wage inflation.
Yeah, we've seen this play out across industries. At tech in particular, there's such a demand for talent. Any CEO will tell you it's their top issue right now, so I think we're going to see only more of this to come.
All right, Bloomberg News technology reporter Ivan Livingstone joining us with some 3 top stories, and we're back with Patrick Armstrong, Chief Investment Officer of Plurimi Wealth. Patrick, I guess, the million-dollar question when it comes to Amazon is that they were before paying in stock. So I don't know whether this is really inflation because they have to increase the base salary instead of going stock because the stock was down.
Yeah, if you had stock options the last 2 years in Amazon, you've not been incredibly thrilled, actually. The stock's been a laggard over that period, especially over the last 18 months. It's done nothing. But it's just symptomatic of everything. So Apple paid $100,000 extra per software engineer in bonuses a few months ago. You've got to pay more. You've got to pay cash. You've got to keep the long-term incentive plans in place. But it's a combination of everything.
So, Patrick, when you look at inflation and people say, look, this is supply, this is actually a wage inflation if you want to get does inflation then cool off if wages go like this in 2021?
Yeah, wages lead to sustainable inflation because it creates higher cost structures and it creates higher spending power. So both sides of the inflation equation go up with higher wages. And you've seen wages rise 5.5% over the last year in the United States, which very high number, but it's actually lagged inflation. So real wages have actually fallen over the last year.
Do you own any Meta?
Meta, we do own Meta, yes. We didn't buy after the sell-off. We haven't sold it. It's a company that's a middling 16, 17 times earnings. It's going to keep producing massive cash flow. So I'm not pounding the table to buy it, but it's too cheap to sell right now.
What about Amazon?
Amazon, don't own it, haven't owned it for years, doing incredible things in cloud, but so is everyone else. If you look at Alphabet, if you look at even IBM, it's going to be a very high growth area. But I think margins won't be able to be sustained in cloud because it's going to be hyper competitive. And I don't think one company is going to have a category killer that everyone needs to have Amazon Web Services versus other competitors.
Patrick, it seems that a lot of the earnings calls, actually the focus away from technology was on inventories. How do you see inventories playing out in the big companies?
Yeah, inventories, it's a potential tailwind for growth as well. And it's everywhere. So it's commodity inventories have been drawn down. You've not seen capital investment from big companies. Inventories are low. I think they'll be replenished. It's something that you've actually seen some sectors as well with inventories builds, but semiconductors is where there's a shortage that's going to stay, and I think that's going to be pricing powers for the companies that are producing those chips.
If we have a sustained rise in yields, where does it hurt most in sectors?
It's the longest duration sectors, so it's the companies that don't have earnings, that don't have cash flows today, that are betting on what will happen over the next decade, the dream stocks, story stocks, and it's higher yields mean lower multiples on revenues for those types of companies. So I do think there's still air pockets. I don't feel that there's been capitulation from the dreamers who thought these companies were going to grow at ridiculous levels forever.
Should we look at consolidation? I know ARM didn't quite go to...
It's happening already, exactly.
Even in banks?
We've been talking about it for years.
For 10 years.
It's going to happen, and that's...
Is it going to happen?
It will at some point. It has to happen because Europe is overbanked. If you get to a point where there's no concerns about bad debts, what's being hidden there, and a steeper yield curve, I think probably we will get it, but it's not happening soon.
Patrick, what was your craziest investment strategy of 2021 that you will not repeat in 2022?
2021.
Can't be crypto.
No, I've not touched crypto. It's something, I think crypto ends at zero, the Bitcoins. It's a speculative asset that has no real purpose, in my opinion. But I didn't do anything crazy in 2021. I think it's been a time right now where it's about preserving and growing purchasing power, putting capital to work in moderate growth rather than chasing massive returns. So it's not a market that I'm incentivized to take those kind of big punts right now.
If you look at a pure macro point of view, I mean, the Asian bonds could actually get a bit of a lift because they're the last ones to normalize. Do you want to play that?
Not playing it now. I prefer the commodity exporting countries, Brazil, Mexico, South Africa. I think you're getting a real tailwind from commodity prices, and it's also improving their credit profile as well. So you're getting very big yields, especially if you buy their inflation-linked bonds from those countries. You're getting inflation plus 2% on a very high inflation rate as well.
Patrick, thanks so much. Patrick Armstrong there, Chief Investment Officer of Plurimi Wealth, joining us with a number of calls. Now, coming up, with our shuttle diplomacy continues as efforts to avert tensions over Ukraine escalating into conflict seek a breakthrough. We have the latest next, and this is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, U.S. President Joe Biden says a controversial Nord Stream 2 gas pipeline between Russia and Germany would be stopped if Moscow invades Ukraine, a plan which Russia has denied. The comment came at a press conference alongside German Chancellor Olaf Scholz.
Of course, there is a military threat in Ukraine, against Ukraine. We cannot remain silent on that. We see the number of Russian troops along the Ukrainian border, and that is a serious threat to European security.
If Russia makes a choice to further invade Ukraine, we are jointly ready, and all of NATO is ready. We're ready to continue talks in good faith with Russia.
Neither Russia nor the Europeans want chaos or instability when nations have already suffered from the pandemic. So we need to agree on concrete measures.
A number of President Macron's ideas, proposals, while it's too early to speak of them, are possible as a basis for further steps.
Now for more, we're joined by our European correspondent, Maria Tadeo in Brussels. So Maria, Olaf Scholz in D.C., Macron in Moscow, they're set to debrief in Berlin. Not much has been achieved. Are you still expecting a breakthrough?
Well, Francine, I would actually say that not in terms of a breakthrough, but these two trips had two different goals. For Olaf Scholz, this was about going to the United States and speaking to, quote, my American friends and making it clear that Germany is a reliable partner. That was the goal of this trip. And yesterday he spoke in English. He took a Q&A, then he went on primetime news to make that case for Germany and kept repeating this message. We are fully aligned with NATO and we're fully aligned with the United States. When it comes to Nord Stream 2, as you know very well, Francine, then it gets very tricky because there's no positive scenario for Germany, whether you ditch it or not. In many ways, they're facing litigation and going to have to pay money that goes to Russia. When you see what Emmanuel Macron did yesterday, well, the French argue that essentially what they did was to take one for the team. That press conference with Vladimir Putin was very rough for Emmanuel Macron, but they believe that France has a responsibility to try to broker a deal. They say they weren't expecting a breakthrough, but nonetheless, they continue to talk. But in terms of the actual specifics, well, you could argue that Emmanuel Macron walked out of Moscow with a nice dinner, 5 hours, but very little on paper.
I know, it was like a six-course dinner and 6 hours of talk with this massive, like socially distanced table, which captured everyone's attention. European natural gas, Maria, in terms of what the markets are doing, really rose following Biden's remarks that if there's an invasion, Nord Stream 2 is dead.
Yeah, and he repeated that message. One way or another, there is going to be no Nord Stream 2 pipeline. Now, for the Germans, having said that, that question was put to Olaf Scholz, Francine, so many times, and it was this idea of why can you not just say, yes, we're going to ditch it? Olaf Scholz did not give that answer, but again, you know, Francine, we know that for the German government, this is very tricky. The thing is huge. It's already built. The Nord Stream 1 is also operational. Now, it depends on the regulator what to do with the number 2, but either way, whether they ditch it, whether they try to sanction it, Germany's in a very tricky situation, both politically, but also the financial strings that comes with the contract. This thing is already signed and built.
Maria, thank you so much. Maria today, of course, with some of the ins and outs of exactly what's going on. If you scratch beneath the surface, it's a lot more complicated. Our European correspondent in Brussels getting to the nitty-gritty of what we should be looking out for. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine, and thank you. Meta has again threatened to pull Facebook and Instagram from Europe if it is unable to keep transferring user data back to the US. It is among thousands of companies that rely on a transatlantic data deal, which was struck down by the EU Court of Justice in 2020 on data security concerns. Europe and the US have been in negotiations for months to replace that agreement. Now, the US and Japan have reached a truce on Trump-era steel tariffs. Washington says it will stop the 25% levy on imports of up to 1.25 million metric tons a year. The solution mirrors the accord struck with the European Union in October. Japan is the 5th biggest steel exporter to the US. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. You and I need to talk about getting off Instagram, maybe. Coming up, we talk about the music industry with Mark Mercuriadis.
the Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Christine Lagarde insists on any adjustment at the ECB will be gradual. Bonds again on the back foot. Markets weigh the risk of tighter monetary policy. Now, DC and Berlin united. President Biden warns Nord Stream 2 pipeline would be stopped if Russia invades Ukraine. And stay with Bloomberg Surveillance Early Edition. Up next, the music mogul Mercuriadis joins us. We discuss Spotify, tonight's Brit Awards, and of course the music industry and returns. Send in your questions on IB Plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first thing is first, a huge turn, especially when it comes to bond markets. We see a repricing when it comes to 10-year yields. This is a global benchmark for treasuries. I have a lot of banks saying, look, if you look at where the U.S. 10-year yield is at and the pace at which it's moved, currently at 193.77, we could see 2%. That's a huge psychological level. Elga Bart of BlackRock actually pushing back that we could see U.S. 10-year at 3%, but what happens after 2%? You know, it doesn't mean that we're out of the woods. And we could see a lot more pain of repricing in the broader markets. Now, onto our music industry. And after decades overseeing the management of artists like Elton John and Beyonce, Mercuriadis founded Hipgnosis in 2018. Now, the $1.9 billion music royalties fund aims to capitalize on the surge in streaming and turn music into an asset class with predictable returns. Over the past 3 years, Mercuriadis has scooped up the copyrights to more than 64,000 songs, and we're delighted to be joined by Merc and Mercuriadis right now. So Merc, thank you so much for joining us. This is going to be a robust conversation on the music industry, which everybody loves, not many people understand, but also streaming and how this evolves. First of all, the Brit Awards tonight. You're excited because you've been pushing for such a long time for writers to be recognized, and finally they will get the chance tonight.
Yes, tonight will be the first time that there's a Songwriter of the Year award at the Brit Awards, so that's very exciting. As you point out, you know, when I started Hipgnosis in 2018, I had my motive, which was to establish songs as an asset class and give the investment community access to the predictable, reliable income that comes from these great songs when they become a part of the fabric of our society. But equally well, I had an ulterior motive, which was to advocate for songwriters, use the platform of our success to advocate for songwriters and to get them the recognition that they deserve, because ultimately the songwriter is delivering the most important component to the music industry, but they are the lowest paid man or woman in the totem pole, so we wanted to change that, and this is a nice recognition of that.
But Merc, when you look at the industry, I mean, it's already been disrupted by the likes of Spotify, Apple, the streaming services. How much more disruption will we see in it?
We'll see a lot, because, you know, we had 16 years of technological disruption, which effectively meant that people could consume music for free via legal downloading. The likes of Spotify and Apple have come through, and in many ways, they've given us the perfect vehicle for people to consume music by, because they're now paying for music once again, and it's made it more convenient to do so. So, you know, the offering of being able to get everything from the Beatles to Beethoven and Chopin to Chic under one roof has made it so that, you know, we've gone from 30 million paid subscribers when we started Hipgnosis to now over 500 million paid subscribers globally to music streaming services.
And I know you've had huge inflows actually of investors wanting to come into your fund. So I guess the question now is inflation goes up. You can't really, because royalties are negotiated so far in advance, you can't really keep up with inflation. Is there a way of hedging?
Well, I'm not sure that there's a perfect hedging solution for inflation, but I think we're a very, very close solution to it in the sense that when people are living their best lives, they're doing it to a soundtrack of great music. Equally well when they're experiencing the sort of challenges. We've had 2 years of COVID challenge. We're now about to have an inflation challenge. People are taking escape and comfort in consuming these great songs. The likes of Spotify and Apple have strong pricing power, and we get a percentage of that price. So as their price increases, our percentage increases as well. So I think we'll do very well out of it.
Does it track inflation?
Yes.
So it tracks, so if inflation is at 7%, for example, the UK, Apple has that power of increasing it by 7%.
Well, I think, we've seen, obviously, Netflix make their increase recently.
Yeah.
I'm not suggesting that there'll be an increase imminently amongst the music streaming services, but that ability is there. I think they have that pricing power.
So your biggest competitors actually in this space are the big, Universals of this world and the big music companies.
Well, they, in the first almost 4 years of having Hipgnosis and acquiring these incredible assets, they really weren't paying attention to what we were doing. Now they've started to pay attention, and you've seen the likes of Bruce Springsteen and you've seen the likes of Bob Dylan, some very, very big deals. But in general, unless it's a superstar, an extraordinary superstar artist of that caliber, we don't really feel them that much.
Mark, I know you've, of course, acquired some things of Neil Young.
Sure.
Was it did you discuss what happened with Spotify and his decision to pull out of Spotify ahead of it?
We did. And, Neil is someone that, if you look at the value of his songs, on the one hand, they're valuable because he's a wonderful artist and he writes great songs. On the other hand, they're valuable because of the way that he's conducted himself throughout his career with integrity. He's always been a leader. So what Neil, the position that Neil has taken against Spotify, which is about a Spotify podcaster, Joe Rogan, spreading misinformation about the COVID-19 vaccine, is a position that's completely consistent with the way that he's conducted himself with his fan base. If we go back to the predictability and reliability of why we would want to buy someone like Neil Young, it's because those fans that make his income predictable and reliable believe in him.
But does it change actually your returns or your relationship with Spotify? They become publishing companies.
It doesn't change our relationship with Spotify because obviously we have a tremendous catalog that's, small in relative terms, but very, very high value, an incredibly high ratio of success within it. So there's lots for Spotify to get stuck in. But in terms of our returns, the interesting thing about Neil is that his consumption has gone up in the 2 weeks since he came off the service. So we're 38% up in streaming alone. I mean, we're hundreds of percentages up in terms of album sales and things like that, but we're 38% up in streaming without Spotify over what we were with Spotify.
I mean, I find it amazing, talking about some of the music that we love in financial terms, and this is something that we haven't really heard in the past. What's the artist that's, seeing the most streamings at the moment?
Ed Sheeran. So we're very lucky. We have, I think at last count, 58 of the 211 songs that have streamed more than 1 billion times on Spotify. And at the very top of that list is Ed Sheeran's Shape of You. Johnny McDade, who co-wrote that song as a part of Hipgnosis, will be presenting at the Brit Awards tonight. Ed is obviously one of the artists of our time.
So how much more do you want to buy? How many more, songs or things out there? And are you fundraising at the moment? Is it easy to find the money?
So we have our public company, which is fully invested at this moment in time. But then we have our relationship with Blackstone as well. Blackstone are a partner, correct. Yep. Blackstone are a partner in the management company, Hipgnosis Song Management. And we have a private fund with Blackstone. And we've announced that we have $1 billion to spend initially with Blackstone. And we intend to do a lot more than that over the next 3 years or so.
So what's the attraction for Blackstone in actually joining forces with you?
These predictable, reliable incomes that come from these songs. Obviously, I think they're, ultimately you could consider them to be the gold standard in terms of private equity.
But
and
it's because
we
you're
have
an
access.
Insider. Right.
Well, we have access. Yeah. My relationship. If I go back to this aspect of advocating for the songwriter as well as working with the songwriter, that has made us the preferred buyer of the songwriting community. So we have this incredible access to the most wonderful artists and songwriters, and of course Blackstone are here here to, on the one hand, help us to invest in those great songs, and on the other hand, they're also here to make us a more sophisticated business. One of the attractions for me to Blackstone is that the music business is very unsophisticated. It's allowed.
In what way?
In the sense that you know, an artist, for example, doesn't know what they're being paid. You know, at the end of the day, you're going to take your pay slip home, and you know exactly what work you put in. You know exactly why you're being paid. That doesn't exist in the music business. So something as simple as that, where a songwriter doesn't know what they're going to get paid for their work. And I want Blackstone to help me make this a more sophisticated business, as well as a better management company for our public fund as well.
So I know that the CMA is also looking at the streaming industry to look at some of the practices. How do you think that will change it?
I think it will. So, you know, this started with the DCMS, the Department of Culture, Music and Sport, doing an investigation into the what they called the economic practices of the streaming services. We applauded that report, but as we gave our written evidence, and Nile Rodgers also appeared on our behalf in person, we said to them, listen, we think as you get deeper into this, what you're going to see is that the relationship that exists between the major recorded music companies and their ownership and control of the major publishing companies has a real impact on how the songwriter is paid, because they want all the money to go towards recorded music. The CMA have recognized that, or the DCMS recognized that, referred it to the CMA, and one of the most important issues in the CMA now is to investigate what they consider to be the dominance of the major recorded music companies.
Do you never not have fun in your job? Because it seems like a pretty cool. It seems like a pretty cool, you know, way of marrying finance and music.
I always have tremendous fun in my job, and I think that ultimately, you know, we're doing something that, as I say, not only allows us to have songs recognized as an asset class, but also gives us a platform to be able to fight for the songwriter. And that's completely in alignment with our shareholders. If we get the songwriters paid more money, our shareholders are making more money.
Do you think Spotify should have cut off Joe Rogan?
I don't think that Spotify should cut off Joe Rogan, but I think they should do exactly what Neil has suggested they do, which is to put health warnings on his podcasts. And I think they should stand up and applaud Neil for taking a strong position.
Mark, what are you listening at the moment? How do you listen, actually? Do you stream things?
I stream things all day long, but I also listen to vinyl, you know, for a lot. Every day I'm listening to vinyl for a couple of hours, at least in the evening, when I'm answering my emails.
That's pretty cool. All right, your boldest prediction for the Brit Awards?
I think, you know, Ed Sheeran is going to be a sensation, and he's playing some of our songs, so I'm thrilled about that. But Pink Pantheress, I think Pink, you know, so, you know, we're obviously in the legacy business, and we're managing these incredible catalogs, but we also have to look at what the future catalogs of tomorrow are, and I think Pink Pantheress is doing something very exciting.
All right, all of our viewers are now checking out, especially the boomers. Merck, thank you so much for joining us. Merck Mercuriadis there, Chief Executive and Founder of Hypnosis. Now, coming up, I've never seen commodity markets pricing in the shortages there are right now. The words of the closely followed head of commodities research at Goldman Sachs, Jeff Curry. He was on this program earlier. We'll bring you that story next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, the upside risk in this market is exceptionally high. One of the reasons why, as alluded to, the markets are incredibly tight from a physical perspective. Whether you see it on the refining margins or in crude oil itself, the entire complex is extraordinarily tight, reflected in that super backwardation. Obviously, what it means is that this market is incredibly vulnerable to any type of supply or demand disruption, very much like what we saw in European gas and power, let's say late last year. So oil has now teed itself up, to look very similar to what European gas and power looks like. That was what we highlighted this risk back in October of last year. We're at that point right now. And so the question is, can you come up with any supply or reduction in demand as you move into the spring to be able to ease the situation? Now, 2008 was a financial crisis. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it. And it's, the backwardation in this market is an indication of just how different this market structure is from 2008. 2008, the curve was going up by the back end, dragging it up. It was in contango at some points in time, which tells you it was paper financial buying on the back end as opposed to outright shortages. This curve is kind of super backwardated, and many of these commodities are super backwardated, which is, textbook shortages. In fact, when Keynes created the idea of backwardation in the 1930s, this was what he had in mind, and we have not seen such types of backwardation. I've been doing this 30 years, and I've never seen markets like this. This is textbook shortages.
That was a Goldman Sachs global head of commodities research, Jeff Curry, there on price surges. And for more from him on the latest energy commodities and markets outlook, check out The Price of Power on Bloomberg.com and YouTube. Now let's get the latest from the tech sector, and let's start with SoftBank as it plans an IPO for chip designer ARM after NVIDIA abandoned a proposed acquisition in the face of fierce opposition from regulators and customers. Well, joining us now is our Bloomberg anchor, Danny Berger, one of my favorite people to speak to about tech. First of all, Danny, when you look at SoftBank, look, this is a major setback for SoftBank.
Yeah, and Masayoshi-san on the call to investors was really surprised, or at least expressed surprise about how tough regulators were with NVIDIA's acquisition of ARM. He seemed to think that this would be okay, that ARM is so influential that, whether NVIDIA or SoftBank owns it, it should go through, but
due diligence. Yeah. I mean, where were they on the due diligence ahead of this, right?
Well, I think that there was a lot of skepticism whether or not they would be able to go through with this deal. But look, it had been going through all the necessary stages. We did seem to be getting closer and closer to it. But so many people voiced opposition, whether it was the people who licensed ARM technology or regulators.
Okay, Amazon. I mean, they're doubling the base salary for a lot of workers. But I don't know whether this is because, not too bad, what, 350,000. But exactly. I don't know whether this is because the stock price was under such pressure, or whether they just need to retain talent at all costs.
Definitely both of them. Yeah. There had been media reports of them in crisis mode about how many people they were losing. 50 VPs.
That's a lot.
That's a lot of VPs, absolutely, especially when you're looking at top-ranking talent. Now, usually they would reward people with stock, to your point. But when Amazon stock isn't doing well, I mean, why would you accept that? Why not go to a company, maybe a private company, where you get paid well, stock price isn't an issue? So Amazon is saying, okay, we might not give as many stock awards, got up the base pay.
All right, Facebook, or now known as Meta, suddenly yesterday we're like, once again, if we don't get the terms we want to by the commission, then we're out of Europe. So are we going to be able to WhatsApp?
I hope so. I hope so. Look, it's really hard to imagine a scenario where Facebook isn't present in Europe, where you don't have Instagram, you don't have Facebook, you don't have WhatsApp. So it does seem a bit of a power play here, but this just goes to the point that Facebook Meta continues to face regulatory scrutiny. Big tech in general does, going back to a conversation about NVIDIA. So this really is a power play on their part. And, you know, politics front and center for Facebook.
There you go, politics left, right, and center, but we still want access to WhatsApp. Facebook, we're less interested.
Yeah,
Our Danny Berger there with the very latest on tech. Now, coming up, BP Chief Executive Bernard Looney on the energy giant's announcement of an additional $1.5 billion share buyback. That's coming up shortly, and this is Bloomberg.
Has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Actually was a good year for trading in 2021. We have a great organization. I'm very proud of them. As we look to the future, oil prices, it's always difficult to tell. I think we've learned early in our career that making predictions isn't always the smartest thing to do. But there is a lot of uncertainty, I think, today. We've got what's going to happen with Iran. We've got what's going to happen with the response, the shale response in North America. We've got concerns in Libya. We've got questions about demand. What happens if there's another variant? So a lot of uncertainty. But what I will say is that demand is strong. And you can easily see a further tightening market
throughout this year. But more than anything, I think we should expect some volatility. And at the end of the day, we don't know what the price of oil is going to be. And that's why we're running our company to focus on a break even of around $40 so that we're resilient to a range of price outcomes. We don't control it, but we do control how we run our business. That's why we're taking out $2.5 billion of cost. That's why we're doubling down on convenience. Convenience sales up 20% over the last couple of years.
Well, that was the BP chief executive, Bernard Looney, speaking to Bloomberg a little bit earlier. And of course, the price, if you look at the share price, if we bring that up for you, we should get it. There you go, 1.5% after the huge dividend. So we were speaking to a couple of market analysts that were saying, yes, it's a good return. And also, we have a great chart that our Valerie put together looking at the difference between some of the renewable space and oil majors. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. ECB President Christine Lagarde says any adjustment to monetary policy will be gradual as the debate over the Euro region's first rate hike in more than a decade does heat up. Lagarde told European lawmakers the central bank would remain data-dependent while assessing the medium-term outlook for inflation. She also warned that price growth could turn out faster than expected in the short term. Last month's U.S. stock market rout is making wealthy investors uneasy. According to a UBS wealth management survey, almost half of high net worth individuals globally said they were highly concerned about a market downturn. In the U.S., 61% said they had more than 10% of their portfolio in cash and in equivalents. One of Mark Zuckerberg's longest-standing advisors is stepping down from Meta's board in May. Bloomberg has learned Peter Thiel plans to focus on supporting former President Donald Trump's agenda during this year's midterm elections and does not want his political activities to be a distraction. Thiel has worked with Facebook for nearly 2 decades. Blackstone is said to be exploring a combination of its European building materials retailer with a similar business owned by CVC Capital Partners. Sources say Blackstone is discussing a possible merger of Building Materials Europe with CVC's Stark Group alongside preparations to list the company. We are told it's seeking to value the business at almost $7 billion in any deal. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Let's get to a lengthy market check because we've seen some wild gyrations in the last couple of weeks, or actually days. Stocks in Europe at the moment are gaining. Commodity producers are receiving a boost from rising metal prices and pretty solid earnings. Now, Treasury yields climbing, the dollar strengthening. Now, on the downside, we had some earnings news from the French lender BNP Paribas. It's dropping more than 3% after fourth quarter revenue lagged some of the cost increases. And then overall, we're looking at retailers with, for example, the online grocer Ocado here in the UK, slumping more than 8% and some of the full year profit disappointed. Now, the story, without a doubt, is definitely what we're seeing. The 10-year Treasury yield briefly rising above 1.95%, a level last seen since December 2019. Some investors predicting it could actually rise as high as 3% this year as the Federal Reserve battles the hottest inflation since the 1980s. I love this chart, and the dollar is also gaining against a basket of peers. This is, without a doubt, the chart that I like the most, and thank you so much for all the people writing in saying how interesting they thought it was. It goes to the fact that the credit market could now be showing signs of stress, raising the chances of a disorderly rise in yields, piling further pressure on global risk assets. So we see a key measure of U.S. corporate credit risk reaching some of the highest since we saw from September 2020. Its European equivalent also soared after some strong U.S. payrolls data and a hawkish ECB stoked expectations for pretty aggressive rate hikes around the globe. Thank you for actually charting these two profiles on the same graphic. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kaylee Lyons in New York, are Anna Edwards here in London. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Central banks have been playing catch-up to the reality of what's happened with inflation.
The Fed needs to move quickly, clearly behind the curve.
I think that we've largely priced in a more aggressive Fed.
The market is now going through a major reassessment of duration risk across assets.
Bonds are down, but not out.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Tuesday, February 8th. Our top stories today. More misery in the world's biggest bond markets. With the sell-off in focus, how quickly does the 10-year Treasury yield get to 2%? President Biden warns Russia the controversial Nord Stream 2 pipeline would be stopped if there's an invasion of Ukraine. Russia has denied it plans to attack. And SoftBank goes to Plan B. It will now take ARM public after NVIDIA abandons a proposed acquisition of the chip designer. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And Kaylee, it seems that, yes, the rising yield environment, reassessment of assets underway as a result, but European equities, at least, fairly resilient in the face of that.
Yeah, and you saw some resilience in Asia as well, Anna, at least when it came to Japan, but other benchmarks were lower, including in Hong Kong and China. And we actually just had the headline crossing the Bloomberg terminal that now state funds in China are stepping in to slow the slowdown in the stock market. However, that didn't take place today because you did see the CSI 300 falling by about 0.5%, taking the broad MSCI Asia Pacific Index down just slightly with it, down less than 0.1%. There's really two individual company stories to note, though, from Asia overnight. One being SoftBank, which Anna mentioned. It did actually see its Vision Fund returning to profitability in the last quarter of the year after having a record loss in the quarter before that. So that's a good thing, but they do have to move to Plan B with ARM, that chip designer, after NVIDIA abandoned that deal. They're not going to take it public. SoftBank shares were down about 0.9% in Japan overnight. The other story I wanted to point to is WuXi Biologics. This is a Chinese biotech company, was placed on the U.S. unverified list. That took the stock down about 20% 23% in Hong Kong before shares were halted for trading. And of course, that does raise some concerns about U.S.-China tensions more broadly. But finally, it isn't just about stocks selling off. It is also what is happening in the bond market. Sovereign debt really under pressure across the world. That was true, too, in Australia. That 10-year yield moving up 12.5 basis points to 2.12%. That is the highest going all the way back to March of 2019, Matt.
Yeah, I'm watching the 10-year yield here, Kaylee, and watching oil as well. Both of them are near levels that could be pretty exciting, although they're just big round numbers, right? S&P futures right now, a little changed. We actually closed the day down on the S&P yesterday, but unchanged on the Dow. The 10-year yield, 19359. So we're watching two. We're on 2.00 watch. I don't know what difference it makes. That's something we're going to be asking our guests, but it's definitely getting closer and closer. NYMEX crude, I was on $100 watch, but we've come down. Remember Friday, we were up over $93 a barrel. So it is, on the one hand, it's pretty aggressive looking at WTI with a 90 handle. On the other hand, we've been here for a few sessions and we're not hitting the highs that we hit last week. Bitcoin coming down a little bit from the price at midnight tonight, but still at $43,932, so getting to that $44,000 level. It's not been a bad couple of weeks for the digital currency. Anna?
Yeah, absolutely, Matt. I like how we like the round numbers. We also think it's a little simplistic to focus on them, don't we? We're sort of torn on that one. Let's have a look at the map then across European equity markets. I was saying to Kaylee how we see resilience across the European equity space in the face of those higher yields. Certainly that's the narrative coming through from treasuries in this morning's European session. That's where the yield story is focused. Europe looks a little more divided, and perhaps that gives some room for European equities to make gains today. And in fact, nearly all sectors in positive territory in today's session. One of the sectors doing really well is basic resources. This plays to the strengths of London, of course, and we see that that sector is up by just over 3%. Nearly all of the names in that sector moving to the upside. I put in euro dollar. This is really a dollar move attached to treasuries, but there is something in it about the euro as well. The euro is considerably weaker then, down 0.3%. It's been doing pretty well through February, though. That's the backstory. 114 is where we trade. BP, the energy major, up by 1.5%. Cash return to shareholders, once again a theme, throwing off cash as they transition that business. We talked to the CEO a little bit earlier on. Bernard Looney will bring you more of that conversation a little later. And Ocado, grocery delivery and technology business, down by 11.4%, Kaylee. A real focus on the extent to which this business has to invest to try and take advantage of the growth opportunities.
All right, Anna, a few stocks to watch in the European session. There is one stock to watch here in the U.S. as well on some breaking news. Peloton CEO John Foley is said to step down and become executive chairman. This is according to Dow Jones, also reporting that it will cut roughly $800 million in annual costs, including cutting 2,800 jobs, affecting 20% of corporate positions. They also, Peloton, planning to drop plans for a new factory in Ohio. We briefly saw those shares moving into positive territory in pre-market, now down 1.8%, actually 2.4%. And remember, Peloton will be reporting after the bell today, so we'll continue to monitor that stock. Now we'll look at what else is ahead today other than Peloton's earnings. Europe Chip Act is to be published. The EU wants to rival the US, but there are increasing doubts about member states and European lawmakers over how to make existing funds available. Also, in terms of earnings, we will get results from Pfizer at 6:45 a.m. New York time. As mentioned, Peloton will be reporting after the bell, as well as Lyft. And finally, we'll get U.S. trade balance data at 8:30 a.m. New York time, Matt.
All right, we're watching for all of that. Also, I mean, really the focus, right? Sovereign bonds extending declines, 10-year yields approaching 2% here. Investors grappling with the implications of a global monetary policy tightening. Let's get some more with Bloomberg's Danny Berger. Danny?
Matt, it really has been remarkable to watch the front end of the curve doubling when it comes to G10 short-term yields. Now, a lot of this is the U.S., it's Europe, this reaction to an about-face from the ECB, more hawkishness from the Fed. But this time around, there are signs that this sell-off in treasuries and global debt could be more disorderly than it has been in the past. And really the indicator here is credit spread. So I have a chart in front of me for our radio listening audience. What I'm looking at is last time we saw 10-year yields rise last year, IG credit spreads, they played along. They were still very thin. But this time, just in the start of this week, we've started to see spreads widen. This often acts as the canary in the coal mine that risk assets are being impacted by higher yields. And it's often sometimes used as the indication, as the push for that Powell put. Now, it's not just this chart. It's not just the U.S. It is Europe as well. Let me take you to credit in the Eurozone as well. Both high yield and IG also seeing spreads widen. It's a little bit of an awkward situation for Christine Lagarde, who in the press conference last week said that they hadn't seen any material impact to spreads in Europe. Well, this is starting to happen. The question, though, is whether this is just a repricing with less liquidity from the ECB, or, Anna, if this is the first signs of a wider debt crisis.
Absolutely, something to keep in focus then. Danny, thank you very much. Bloomberg's Danny Berger on the markets. Let's get back to geopolitics. The French President Emmanuel Macron will travel to Ukraine today to meet with President Volodymyr Zelensky, a day after Macron sat down with the Russian President Vladimir Putin in Moscow. Meanwhile, President Biden taking a firm stance on Russia after meeting with the German Chancellor Olaf Scholz at the White House yesterday.
If Russia invades, that means tanks or troops crossing the border of Ukraine again. Then there will be no longer a Nord Stream 2. We will bring an end to it.
Now, Moscow has repeatedly, of course, denied any plans to invade Ukraine, which we should keep pointing out. Our European correspondent Maria Tadeo joins us now from Brussels, and our Washington correspondent Joe Matthew is with us from DC, both to lend their analysis. Maria, let's start with you, and we're just actually getting some lines coming through from the Kremlin. On the one hand, conciliatory, saying that the Russian troops will return to base after their Belarus exercise, so conciliatory at least on the troops present in that country, but then also saying Russia and France reached no deals on security issues. The West is not ready to take Russian concerns into account. What's the latest?
Well, Anna, two things. One, of course, is that you could argue it's a positive sign that these troops are being pulled back. The concern, particularly for NATO, was that we could see that troop buildup in Belarus increase. So this points to the opposite. But it's interesting that the Russian government is clarifying that meeting with Emmanuel Macron yesterday. We know that this was almost a 6-hour meeting that they had. And interestingly enough, yesterday, the French seemed to be briefing that they had some sort of promise from the Russians that there would be no more military initiatives along Ukraine while the talks are ongoing. Now, what the Russians are saying, perhaps clarifying this comment, is that yesterday in this meeting between Emmanuel Macron and Vladimir Putin with no one else but their translators, is that there was nothing on paper, that nothing was agreed. Now, funnily enough, we are also hearing from Emmanuel Macron, who's just landed in Ukraine, saying, when you ask me what did I achieve in this meeting, well, I would say there's been no escalation and there's been no degradation for the situation. So for the time being, that is good enough.
All right. More importantly, Olaf Scholz from Germany was here meeting with Joe Biden from the USA. And Biden seemed to make promises for Scholz that he will find very difficult to keep when he returns to Berlin.
Look, two things. When you speak to the Germans, the goal behind this meeting, they argue, was about damage control. They were concerned about the criticism that Germany has been soft on Russia. This has been an idea building for weeks now. So Olaf Scholz wanted to send a very clear message to the U.S., for years, in fact. But he wanted to send a clear message that NATO and Germany and the United States are fully aligned. He gave an interview yesterday on primetime TV. A lot of this was damage control. They wanted to really contain the criticism. The second point that you allude to, Matt, is about the Nord Stream 2. President Biden said there would be no Nord Stream 2 if Ukraine invades. But you know very well that this is not a yes or no answer question for Germany. If they ditch this, and the thing is already built, I mean, this is done already, they could face litigation, taxpayer money could go into this, and this could be a very tricky legal situation too for Germany. So I would argue, to Olaf Scholz's credit, this is not just a yes or no question to the Germans. We're simplifying a question that's actually very complex.
All right, thanks to Bloomberg's Maria Tadeo in Brussels with the view from Europe. Now let's get the view from Washington and head over to Bloomberg's Joe Matthew in D.C. Joe, what's the Biden administration's feeling on how yesterday went and whether Biden and Scholz are on the same page?
Well, the president was definitive. President Biden, Chancellor Scholz met for the better part of 2 hours, not quite the marathon session that we saw between Macron and Putin. In their joint news conference that followed, Sanctions were the primary topic here, and Nord Stream, to everyone's earlier point here, really dominated the conversation. The president was definitive, as you heard coming into this. We will bring it to an end, referring to the pipeline if Russia were to invade, which again, it says it is not planning. Despite repeated questioning, though, Chancellor Scholz never actually said the name Nord Stream 2 out loud. Reporters were quick to point this out. He did agree with President Biden at just about every turn, however, and he did break into English at one point for emphasis, saying, quote, "We are acting together, we are absolutely united, and we will not take different steps." Earlier, Germany's foreign minister said the country was willing to pay a high economic price if Russia, in fact, chose to cut off gas to Europe. And we should note, incidentally, today, President Biden, who will certainly get more questions on this, has an event scheduled for this afternoon in which he will be speaking to the American people about efforts his administration is taking to, yes, lower the price of energy for everyday Americans.
And he has to take a victory lap on his foreign policy right now, because the House is looking at a stopgap bill to continue a continuing resolution for the budget. And this was supposed to be the year that, Build Back Better really bolstered the Democrats' platform, but it doesn't look like that's going to happen.
Well, it's supposed to be the year regular order returned to the United States Senate as well, which we're kind of waiting to see here. This in itself would be a big deal, Matt, having lived through continuing resolutions, kicking the can for months upon months. Since October, in fact, the country has been operating under a continuing resolution, and they're going to pass another one today. To your point, the Senate will follow the House, but it does appear, this will go through March 11th, Matt, that they're on the verge of a breakthrough. We'll have a $1.5 trillion budget if all 12 appropriation bills get done in time here. That would unlock not just the top line number, but the billions of dollars in the infrastructure law that need to go out to communities to start work. So that would be in itself considered a win, while normal business for most in Washington, a win for this White House.
Joe, thank you very much. Bloomberg's Joe Matthew. You can listen to Joe every weekday on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now, on to tech news, and NVIDIA is abandoning its purchase of ARM from SoftBank, bowing to regulatory opposition. SoftBank now plans to proceed with an IPO of ARM in lieu of the deal. It's like Back to the Future feel about this one. Let's get more from Bloomberg's Tom McKenzie, who joins us on set here in London. Tom, I remember when ARM was listed in London, and then it wasn't anymore, and it was part of SoftBank. But here we are. What's the latest update?
So this may happen in 2023. It's likely to happen in the US. The IPO of ARM, the Cambridge, UK-based designer of chips, of course, a sector that has only developed and gained more prominence in the last 2 years, the crucial factors around this space. And what the concerns were around this, and you remember this, the regulatory concerns, of course, most pronounced in the US, but you also had the sense that the Europeans, the UK, even the Chinese were unlikely to sign off on this deal for ARM to be sold off to NVIDIA. The regulatory concerns because of the lack of neutrality. That was the concern, at least, because SoftBank did provide that neutrality. They didn't compete with any of ARM's customers. And of course, ARM supplies to everyone from smartphone makers to automakers. Then you had the concerns from the customers. Okay, that ties into that regulatory scrutiny. So the deal is off. SoftBank are going to get $1.25 billion as the breakup fee, but SoftBank have a whole load of other concerns. They've got exposure to Chinese technology. That's been a drag, particularly Alibaba, one of its biggest assets, which is down about 50% over the last year. And of course, they have that broader sell-off that they've had to factor in around the tech space. So they're having to adjust. Masayoshi Son coming out on the back of these earnings saying that the storm is getting stronger, particularly in the United States. But for ARM, yes, we're looking at an IPO, likely in the US. The question is, can they raise as much? They were going to sell for about $40 billion US. We'll look to see whether they can attract that kind of valuation.
All right, Bloomberg's Tom McKenzie with a look at one company we're watching. Thank you so much. Let's take a look at some others that are moving in pre-market trading here in the U.S. as well. One being GM. Adam Jonas over at Morgan Stanley downgrading this stock because of a weaker 2022 outlook. He also has some questions about the viability of EV industrialization. That stock is down about 3.6% before the bell. Another stock moving lower is Take-Two. The video game maker gave a weak revenue forecast after the bell yesterday. Investors really waiting for answers as to the timing of the next installment of the Grand Theft Auto franchise. I feel like that might be a video game that Matt Miller is pretty into. That stock is down about 2.4%. And finally, also to the downside, Peloton. Shares were already lower. They have gone even lower on the back of that Dow Jones report that the chairman, that CEO John Foley will be stepping down and becoming executive chairman. They're also going to do some cost cutting, cutting 2,800 jobs, according to that report. It will be reporting after the bell today, so I'm sure we're going to get more information on this, as well as any potential conversation around a potential takeover number, Anna, but right now that stock is down about 4.4% before the bell.
Our Bloomberg opinion colleague, Andrea Felsted, writing a piece to Peloton saying, come on, just do it. Just go court Nike. We'll see if that kind of tie-up becomes attractive to anybody involved. Coming up on this program, Beata Manthi, Citi, head of European equity strategy. She'll join us. Why this resilience for European equity markets in the face of the rising yields and the deepening bond rout. How the market is responding to the prospect of supersized rate hikes. If that is what we get, how will inflation data this week play into those assumptions? Plus, BP boosting buybacks after hitting its highest profit in more than a decade. Part of our interview with the company's CEO shortly. This is Bloomberg.
Variant and the latest wave have an impact on not only consumer trends but your business, and do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida, and I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kaylee Lyons, Anna Edwards with us in London. Now, we have been watching to see when the blood in spreads. We saw it first in sovereign spreads. Now we're seeing it in credit spreads around the globe would hit risk assets. We're certainly not seeing that in Europe today as the indexes rise 1% and change. Let's talk to Lynn Thomason about that, Bloomberg managing editor for EMEA Markets. Lynn, you know, Mark Gilbert in his piece today was saying at some point this is going to affect companies that can't borrow for as cheaply as they once could, and yet we're not seeing that reflected in stock prices. Why not?
Yeah, that's a really interesting question. I mean, I would almost, it's almost, we haven't quite gotten there yet for it to filter through the companies. I think, you know, compared with supply chain chaos, COVID, inflation, you know, perhaps the borrowing cost story will come a little bit later down the line. I mean, I think now everyone's talking about, you know, how are tech companies and, you know, the wider economy overall going to deal with the supply chain story.
Good morning to you, Lynn. Does this cause real pain for companies? Do they just not refinance as rates go higher? Is that what happens here? They just stick with the deals they've got, and if I suppose the ones that will be in pain are the ones where their deals end and they roll over and there's higher rates to roll onto.
Yeah, absolutely. I mean, there's a big sort of like if you wanted to refinance, the time to do that was a few months ago, and now you're perhaps seeing a bit of a slowdown. I mean, I think the other thing to keep in mind is reality is, rates are still relatively low compared to history. So yes, they are increasing, but I mean, if you look on a historical level, borrowing costs are fairly cheap compared to, say, a few years ago.
And if you have the pricing power, that might still look okay for a corporate. Lynn, thank you very much. Bloomberg's Lynn Thomason with the latest on the markets. Remember, you can get market analysis. Check out MLIV Go on your terminal. That is the function to use to get across the Market Live Teams blog. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Time now for the First Word News. And in Canada, Prime Minister Justin Trudeau is blasting the protest by truckers that has now halted commercial traffic to the U.S. at the busiest border crossing. The protesters say they won't stop until all COVID restrictions are lifted. Trudeau says they are hobbling the economy and trying to undermine democracy. Meanwhile, Hong Kong is ramping up restrictions as it fights an unprecedented COVID outbreak. The city is extending limits to private premises for the first time. Multi-household gatherings will be limited to 2 families, and Hong Kong's also expanding the list of venues included in its vaccine mandate. And billionaire Peter Thiel is leaving the board of Facebook's parent Meta to pursue Donald Trump's agenda. Bloomberg has learned that Thiel will focus on backing Republican candidates for Senate who advance the former president's policies. Thiel has advised Facebook founder Mark Zuckerberg for almost 2 decades. Coming up, we'll get back to the markets, take a look at this bond market rout globally and what it means for equities with Beata Manti, head of European equity strategy at Citigroup. This is Bloomberg.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Here is what you need to know. That sell-off in the world's largest bond markets is widening. That could push the benchmark US 10-year Treasury yield past 2%. Yields have surged about 80 basis points since August. Traders have been betting on Fed rate hikes this year. A warning from President Biden. He says the controversial Nord Stream 2 pipeline between Russia and Germany would be stopped if Vladimir Putin orders an invasion of Ukraine. The president's comments came after a meeting with Germany's Chancellor Olaf Scholz. Russia has repeatedly denied it plans an invasion. And in corporate news, SoftBank now plans an IPO for ARM. Nvidia dropped a proposed $40 billion takeover of the chip designer after regulators and customers objected. SoftBank will get a breakup fee of more than $1.2 billion. So, That's the focus in terms of corporates, in terms of the macro environment. Matt, what are you focused this morning on as we head towards the start of U.S. trade?
Well, I have to say, I think SoftBank is actually going to bag about $2 billion in total. So it seems like that's pretty good money for the work, right? So SoftBank now moving to Plan B, very interesting. In terms of U.S. markets here, we're watching S&P futures doing a whole lot of nothing. So what we're really focused on is the U.S. 10-year yield. You mentioned that round number of 2% is interesting if for no other reason than that it is a round number, but it's also been a massive climb, right? Just Thursday, we were looking at a 7 handle here, and now we're on a 9. So watching the 10-year yield continue to climb. NYMEX crude slipping now back down below $90 a barrel. It was 93 and change at one point during Friday's session. So it's still strong. Prices are still relatively high, but we're not getting up to that $100 number that a lot of people on the street have forecast. In fact, yesterday, I heard Phil Orlando from Federated Hermes say he thinks 110, 120 by year end for crude. And then Bitcoin is off from the price at midnight tonight, but it's still higher than it was yesterday when we talked about it. $43,815, headed for 44. So keep an eye on Bitcoin continuing to move higher. Kaylee, what are you looking at in terms of pre-market movers?
Well, there's a couple stocks that are moving higher, Matt. Both of them actually report before the bell today. Coty Beauty and Pfizer, both getting bid up ahead of those results. Coty Beauty actually is higher by the better part of 5%, while Pfizer is up about 1.7%. Of course, with Pfizer, a lot of focus will be on the sales guidance for its COVID-19 vaccine. To the downside, though, General Motors down a little more than 3.75% after Adam Jonas over at Morgan Stanley downgraded the stock on the weaker 2022 outlook. Also, some questions about execution risk as far as EVs go. So that stock is moving lower, as is Peloton, which we'll be reporting after the bell today. Remember, this stock up more than 20% yesterday on reports of takeover interest from another number of different companies. Now we have reports this morning that the CEO, John Foley, will be stepping down to become executive chairman, as well as some cost-cutting efforts underway. I'm sure we'll hear more about that throughout the day, and especially after those earnings, Anna. But ahead of all of that, Peloton is down about 3% before the bell.
Okay, and in terms of the European picture then, Kaylee, we said half an hour ago that things were looking pretty resilient, and they are. We still have moves to the upside on the Stock 600, up by 0.4%. But we don't necessarily have quite the breadth we did. Nearly all sectors were in positive territory half an hour ago. Now, it's around 2/3 of those sectors. One sector doing really well is basic resources. Nearly all of the stocks in that sector moving to the upside as we digest higher commodity prices. Support from China for steel makers. Better for them, better for their profits. Maybe not so good for the environment, but certainly something that is boosting mining stocks today. The euro is in focus, or is it the dollar? The dollar is definitely in focus as we see higher yields over in the United States. That is pushing demand into the greenback. The euro paying a little bit of a price there, down 0.25% at 114 is the handle. BP, that's certainly a stock we're watching because of the scale of the reporting that we got out of this energy giant. They are, of course, an energy giant in transition from oil to other things. We heard a lot about their capital expenditure plans, also about buybacks, and that was something that certainly lifted the share price at the start of the trading day. And Ocado, grocery retailer and tech business, sells its technology around the world, of course, or operates its technology around the world to grocery businesses, not just in the UK. But the focus really for investors, and the reason we've seen the weakness in the share price is it really all worth it? All that investment to try and keep pace with the opportunities in that sector. A focus on the amount of capital expenditure they have to endure, Matt.
Right, especially in a rising rate environment. Joining us now to talk about that is Beata Manti, head of European equity strategy at Citi. Beata, in terms of spreads, you know, we've all been watching them blow out, especially on the periphery, but even core rates are rising at a rapid pace. I believe the bunds have risen for 10 sessions in a row. If they falter today, that'll end the streak. But those yields haven't risen for 10 sessions in a row since the year 2000. At what point does this affect company costs and hit the equity prices? Because for now, European equities are still doing really well.
Hi, much. Thanks, guys, for having me. So everything in equity markets recently have been a bond trade, right? It's just different parts of bond markets have been driving different parts of equity markets. When it comes to the recent rise in the European periphery spreads, we think this is really the reaction, the natural and expected reaction to the more hawkish ECB. So that's what the market is trying to reprice right now. So it is plausible we are now going to get a rate hike from ECB by the end of the year in the fourth quarter, and really periphery spreads have been always more vulnerable, right? So we think there is no panic yet. You know, the spreads have come up. However, they are not at alarming levels, and we don't think at that point they are a risk to the equity markets. However, if they were to rise much more and faster, then of course you would start looking into risk of environment, and the most vulnerable part of equity markets to excessively high spreads would be banks.
Okay, so that's the bank link. We have explored that a lot over the last 10 years, and we'll continue to do so as it becomes relevant, Beata. One thing you point out in your notes to us is that you want to buy the dip in some technology names. Does that extend to, is that European technology names? Because I see that we have a dip in European technology today, even as the rest of the European equity space is rising. Tech is a weak spot.
Absolutely. So we've been always worried that growth stocks would be vulnerable to the rise of interest rates, and especially the one bit of the bond market to observe is to focus on, if you're interested in tech stocks, is the direction of the real yields. So our view is, and the view of our rate strategists, is that the move higher on the real yields have been so steep that perhaps we'll have some consolidation in the near term. And when I look at the reaction of the European tech, we really see this being in oversold territory. So the level of the current real yields would suggest European tech should be trading at around 26 times PE. It's trading at 23 times PE. Last time it was trading at these levels, US real yields were at zero, not at negative 50 basis points. So a lot of this further move is already in the price.
All right, so you've seen tech reacting to yields. Yields have been reacting to central banks. And when we think about the ECB's hawkish pivot in particular, Goldman Sachs actually just published this morning saying that especially in Europe, there's signs that the problems that plagued Europe in the last cycle, low nominal GDP growth, disinflation, no earnings, are finally diminishing. And that is actually what this hawkish pivot signals. Do you agree with that?
So if that's the case, of course, this is the positive for the market, right? But at one point, the market is going to start worrying that perhaps ECB is doing things too fast because of the inflation being stubbornly high, and eventually it will hurt growth. You know, the reaction of the spreads, coming back to which we've discussed at the beginning, doesn't signal that yet.
Beata, thank you very much. Thanks for your time. Beata Manthe, Head of European Equity Strategy at Citibank. Thanks for joining us. And don't miss Bloomberg's monthly series, Chief Future Officer. The latest episode features the Mondelez CFO, Luca Zaramella. You can also check out our interview with the Macy's CFO, Adrian Mitchell, on Bloomberg.com and on YouTube. This is Bloomberg.
is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London. Let's get more on that breaking news on Peloton. The Wall Street Journal reports the CEO, John Foley, will step down. He does become executive chair, though, so he's not leaving the company. The stock falling in pre-market trading. Andrea Felstead, Bloomberg opinion columnist, joins us now for more from London. So this is a company that has been pummeled, but looks now, Andrea, like it's in play as a possible sale.
That's right. We've had reports over the last few days that Amazon and Nike were looking at the company. So, yes, clearly. So it's either looking for an independent future by doing this, or it's trying to show that it has an independent plan to get a higher price.
Okay, Andrea, good morning. So of the potential bidders, and we'll see who actually comes out of the woodwork here, but Amazon, you mentioned, Nike also being discussed. What would make most sense as a sort of union?
I think Nike would be the better combination, because Nike's whole ethos is fitness. And when you look at some of the Nike price points, at the higher level, they're clearly upper premium, approaching luxury, and that's the same positioning as Peloton.
Well, obviously, we'll get a better picture of Peloton's exact position when they report after the bell and get a picture of what demand is looking like. Why would Peloton be an attractive asset given some of the trials and tribulations it has had with waning demand for its products as we emerge from the stay-at-home world?
It can give an acquirer lots of data about its well-heeled users, and they can use that to sell other products to them.
So who are the other likely suitors? I mean, is it possible that we see an Apple come in? Why am I hearing about Disney?
Apple definitely makes sense. For Disney, I guess it's the streaming wars. It's getting people in front of those screens for longer time. And again, it's the data.
It's all about the data. Thank you so much to Andrea Felstead of Bloomberg Opinion for that news on Peloton and getting her insight. Now, we want to focus back on the bond market. We are starting to see a little bit of a reversal in European yields today, specifically on the periphery, where yields are now starting to come in. But really, it doesn't go that far to reverse the dramatic moves we have seen since last Thursday when Christine Lagarde gave that more hawkish press conference. What we've seen is spreads blowing out really across the periphery. And I have a chart here for listeners on London DAB Digital Radio. Basically, all you need to know is it shows Greece, Italy, and Spain's 10-year yield, the spread over the 10-year German bund yield. Those have widened out substantially. For Greece, now 225 basis points above the bund. For BTPs, now 156 basis points. Let's get more now with Marcus Ashworth, Bloomberg opinion columnist, who covers the European markets for us. Marcus, as I said, we're starting to see a little bit of a reversal of the moves today. Is this a move that has been overdone and is now correcting?
Yes, I think is the simplest way of putting it. I mean, it's not much of a correction, particularly for Italy, but I mean, the Greece thing was just a classic illiquid, very small market, one or maybe two large sellers. I don't know, we have Japanese year-end coming up. It's possible that someone's just decided ahead of French elections and a wide variety of changes, clearly, of what's on the ECB's thinking. I mean, it's evident that Lagarde has not rowed back on her comments of Thursday, which I think she was forced into making by a significant minority on the governing council, saying they wanted policy change last Thursday, which is really quite shocking. That, but she's controlled it. She made clear to say that she backed the peripheral and there will be ongoing support and it will be gradual. And that's really what people needed to hear to calm things down. However, this is a fundamental repricing of European risk.
So things do look a little calmer this morning, but a fundamental repricing underway, you say, Marcus. Tell us about the Greek specifics here, because a lot of people talking about how Greece is different depending on which of the asset purchase schemes the ECB currently has in play. And if we're going to transition from one to another at some point, it will become critical to know when that is, to know how much support Greece is going to get and Greek debt is going to get from the central bank.
Okay, I think it's a bit of a storm in a teacup. First things first, I mean, Lagarde made clear, and the ECB made clear on Thursday, that though they still haven't got around to altering the existing and what's about to replace the pandemic program, so that's the APP, that's what's going to become, for probably only a very brief while, the main and probably only buyer of European bonds, that cannot buy Greek debt. They haven't bothered to change it. Probably no point. The reason is they're going to stop it fairly soon anyway, certainly before the end of this year. The existing PEP program, which is miles bigger and a lot more flexible, has so much reinvestment power, 440 billion euros probably this year alone. It can do what it wants. That's got more than enough cover for Greece. Greece itself has done so much in the last few years to overborrow when it had the window. It's taken it, having been shut out of the bond markets for so long in Europe. It's got plenty of funding in the locker. It doesn't need to worry. It's just a small, minuscule market, very liquid, with one large seller yesterday.
And, well, underestimating Greece as well as Spain and Italy was a problem in the past for the ECB. I noted in Mark Gilbert's column, Rupert Harrison tweet that I thought was just really interesting. Rupert says that it really feels like central bankers around the world are making a collective policy mistake, trying to use rapid rate rises to cool inflation that's driven mainly by supply constraints, just as growth momentum is slowing. Is this a problem, Marcus?
No, Rupert Harrison's a very interesting guy. I disagree with him on supply constraints. I think they're going. I think growth momentum is there. We can see that from the non-farm payroll numbers alone in the States. I'm not so worried about growth. However, he's very right to point out the possibility of this, and this is clearly the ECB being browbeaten and dragged against their will to start having to do something about inflation. Look, I think Jim O'Neill put it best yesterday. You know, why have we still got QE? Why were they still doing QE all of last year? It's madness. We need to think about forgetting about inflation targeting and sorting out how central banks are run, because they've been asleep at the wheel and allow this inflation boost to carry on and get out of control. And now they may possibly be panicking. The only thing that gives me confidence actually is Jerome Powell. People seem to misunderstand his wording. He said they're going to be nimble, the Fed. That means they don't always just have to hike 5, 6, 7 times, as some people think. They will probably almost certainly stop if they overdo it or think they're going to overdo it. And that's what we have to hope for. But the central banks have learned that lesson, and equally the ECB have learned.
Okay, Marcus, thank you very much. Yeah, cheap money. Not always been a fan of the quantitative easing programs. The world gets back to the right side of zero, writes Marcus Ashworth this week on the Bloomberg Terminal. A Bloomberg opinion columnist covering European markets. We thank Marcus for his time. Coming up, we'll get back to the corporate agenda. BP boosting buybacks after hitting its highest profit in more than a decade. Part of our interview with the company's CEO next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
A lot of uncertainty, but what I will say is that demand is strong, and you can easily see a further tightening market throughout this year. But more than anything, I think we should expect some volatility, and at the end of the day, we don't know what the price of oil is going to be.
That was the BP CEO Bernard Looney speaking with Bloomberg TV earlier on today. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. Interesting that there's a company, Tom, that's benefited, of course, from higher gas prices, higher oil prices. Yeah. Is there a little bit of geopolitics in there? We see oil prices coming off this morning. What's on your mind?
It's a Matt Miller message. I mean, he's driving the H2 around northern New York City here, and it's, you know, I mean, it's up 5% since the beginning of the year. Oil's up 5%, AAA unleaded gas as well. Anna, let's look at inflation. This is not only oil, it's rent, and the rest of it as well. We're getting ready for that huge inflation report that we see here in a few days. In white, services, elevated always, 3% service inflation for a number of years. Goods, outright deflation, disinflation, quiescent, as Chairman Greenspan would say. And then we had a pandemic. We moved from 1.5% goods inflation to 3.7% goods inflation. Service sector goes right up to the same point as well. So we've got a blended 3.7% is part of that ugly single statistic of 7%.
I will be, without telling you what cars I'm driving, Tom, this month, there will be a twin turbocharged 4-liter V8, a naturally aspirated 6.2-liter V8, and a supercharged 6.2-liter Hemi. With that said, isn't it good that gas prices are up to the highest they've been since 2014? Don't we want to reduce carbon emissions?
I would say that's a tertiary factor. It's definitely there, Matt. You're absolutely correct, but it's overwhelmed by other factors, and the major one right here is political. It'll be interesting to see off of the inflation report on Thursday how the White House and others react. What's important here is 1 month of 7%, 2 months of 7%. What if a third or fourth month is elevated like that? That changes the dialogue.
All right, well, we'll wait and see how that data unfolds on Thursday. Thank you so much to Tom Keene, co-anchor of Bloomberg Surveillance. He didn't get to tell us what he's driving right now. We'll have to get him back to talk about that next time. I am watching geopolitics right now, though we just got some headlines out of Emmanuel Macron, who was speaking to reporters after his talks with Vladimir Putin in Moscow yesterday. He says he got assurances from Putin of no more escalation, and we actually are seeing oil markets reacting to that headline in that crude is moving lower, down about 2 percentage points on Brent, WTI down by about 1.8%. So maybe some of that geopolitical risk premium starting to come out of the oil market. But it's interesting, we aren't getting consistent messaging between Macron and Russia, because the Kremlin said earlier that Russia and France reached no deals on security issues. So I think we're going to have to wait for some more clarity, Matt.
Absolutely be watching that, the oil market, watching it closely for sure. We're also watching Peloton, not only because earnings are coming out after the bell or because the CEO is stepping down to become the executive chairman, but mainly because they're in play. They could be taken over. Andrea Felstead, just joining us, says Nike could be a possible suitor, but we've heard a range of other names from Amazon and Apple to Disney, which I think is interesting. I do want to point out, there is only one way to pronounce Nike properly. That's the way the people who founded the company say it. And while we're on the subject, there is only one proper way to say Adidas. Because the name...
I feel this message is landing at my feet. I'm with you. I mean, it's not difficult, Matt. We lead American with Nike. We lead German with Adidas. I think I'm on board with your messaging there. I probably got my German pronunciation wrong. I'm looking at a corporate as well. I'm looking at ARM, the future of ARM. I remember when it was listed in London, when it was such a tech darling. I remember the disappointment, the politics that was playing out as we saw it being swallowed up by Japan's SoftBank. It's coming back to the market, but looks as if London may miss out. Likely to go to the NASDAQ. back, is what we're being told. ARM CEO Rene Haas, actually quite new into the role, talking about the opportunities for the chip designer in autos, some cars having 30 to 40 chips. He pointed out cloud computing, obviously another opportunity that this chip designer is working on extensively. More Bloomberg surveillance is ahead. We'll hear from Jim Caron of Morgan Stanley and Francis Donald of Manulife, amongst other voices. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Fed is basically in the market right now.
Markets for the first time in quite some time are facing less liquidity and tightening economy overall.
The risks are that the Fed does have to move a bit more aggressively.
The flat curve is not ideal for the Fed, but I think it's perhaps a better evil than a very steep curve.
We're in a rising rate environment everywhere.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market up 0.1% on the S&P. The attention, once again, TK, on the bond market.
I'm going to go 2 days to the inflation report, and it links right into that bond market. We start strong, John, with Jim Caron, and I start with a 10-year real yield out to a new, lesser negative statistic, negative 0.4855. The trajectory of the real yield speaks volumes.
And a breakout in the front end on a nominal 2-year yield as well, comfortably through 130 through the last 24 hours. We need to talk about restrictions as well, Tom, so let's do that. Australia opening itself up to tourists. We've got states across the United States of America loosening mask mandates. We can talk about that later. Sweden dropping most curbs, and Hong Kong coming out with its toughest curbs yet. going in a very different direction.
Going another direction. I know it's really affected Cathay Pacific and, of course, Global Wall Street in Hong Kong. John, what I would point out is cases, mint, hospitalizations, not quite as mint, but still mint. We need deaths to roll over in America. Statistically, they have not yet.
And Lisa, you can assume that will follow.
Yeah, you can assume that that will follow. The interesting thing is, are we seeing a COVID zero fail? Are we seeing that policy officially failing to really stop the spread of the virus over in Hong Kong, over in China? And will this mean that they will be more forced to release it, especially if the Olympics are done?
Multi-household gatherings on private premises will be limited to 2 families, Lisa, in Hong Kong. That feels like, never mind 2021, but 2020.
And the social implications also, I mean, you look at the protests going on in Ottawa in Canada, the truckers that are absolutely livid over some of the curbs that they're seeing on their freedoms, on their ability to move around. You have to imagine there's a similar sentiment in China where people are sick of not being able to see their families.
And some important elections coming up in various places as well, particularly in Australia. Equity futures on the S&P unchanged this morning. Good morning to you. On the Nasdaq, slightly negative, but no drama. We're down just 0.02%. The attention goes to the bond market. Yields up by a basis point or two to 193 on 10s, up on 2s, through the curve. Lisa, as Tom points out, it's about real yields.
This is about real yields. It is not about the nominal yield. It is not about the fact that the Federal Reserve is providing some sort of buffer to forget the inflation expectations. This is being driven as inflation expectations continue to decline actually throughout the year. 8:30 a.m. Here's what I'm watching today. We get the U.S. December trade balance, which is poised to be the most significant trade deficit in data going back to 1991. What is the significance of this? A lot of companies have ordered a lot of goods ahead of this year, expecting those supply chain disruptions. Inventories are high. People are expecting this trade deficit to actually ease throughout the year. At 1 p.m., and Tom, I'm doing this just for you. The Treasury is planning to sell $50 billion of 30-year notes.
Back to normal.
Yeah, exactly. And this comes, of course, as that 3-year yield is the highest going back to the beginning of the pandemic. And just to give you a sense of what we can expect throughout the week, this is for you also, Tom. Tomorrow we could talk about the $37 billion of 10-year bonds that are going to be sold. And Thursday we've got $23 billion of 30-year bonds. And aftermarket, Peloton is reporting earnings. The reason why this is going to be particularly interesting. Well, that probably they might avoid that, especially given their speculation that they could be acquired by Nike or Amazon. And we did have the CEO and co-founder John Foley step down this morning. New management really stepping in. You do wonder what the regulatory concerns would be if Amazon takes over Peloton at this point.
And John, Poonam Goyal was just brilliant yesterday in one of my other properties. She made real clear this is about Nike and less about Amazon. She said she'd be stunned if Amazon stepped in here.
What's your other property called?
I can't remember, frankly.
You've forgotten the name?
I
think that's also called Bloomberg Surveillance.
I think so as well.
Jim Carrey joins us now, fixed income portfolio manager at Morgan Stanley Investment Management. That was a trick question, Tom. Jim, 50 basis point rate hike in March. You actually think we should take this seriously? Why?
Well, you know, I think, well, first of all, thank you for having me on your show. Yes, no, I do think that we should take it seriously because what we're starting to see is that inflation pressures are starting to rise more precipitously. We have another inflation number coming out on Thursday. We've recently had, I know for some technical, quirky reasons, a stronger payroll report. Right now, what central banks are worried about, and this is the one job central banks all around the world all have in common, which is fighting inflation, is that you're starting to get a steeper Phillips curve and you're getting wages starting to move higher. That's allowing companies to pass through higher prices. What that does, and this is the important point, is that it unanchors inflation expectations, which means that corporations are therefore more likely to more freely raise prices in the future. Consumers are willing to pay those prices, and that's a spiral inflation that we're talking about. So if we start to move into a situation where the Fed starts to really take this very, very seriously and they're concerned, I can't rule out a 50 basis point rate hike. It's not the base case, but I think we should take it very seriously.
Jim, what's your dynamic on what foreigners will do given higher yields across all of the Morgan Stanley yield space? Do foreigners go into a voracious frenzy when they see higher yields? Do they get afraid and wait? Well, how do they respond?
I think it's the latter. I think when yields are rising, they get afraid and wait. Once yields settle down into a range and people are comfortable with that, that's when you start to see the buying. So when we see these yield rises, we do think that there are some limitations as to how high these yields can go as it feeds back into financial conditions, as it feeds back into growth, and it impacts other asset prices like equities and things like that and credit. However, when you start to see these types of moves, they become somewhat unbounded. So if we're looking at the 10-year Treasury at 1.93%, well, what's to stop it from going to 2% or to 2.05? I think people would be more comfortable with it above 2% to say, well, maybe now's the time to start to buy. But when we're making that journey up towards 2%, people tend to get very, very nervous and want to, seek out shorter duration protection.
Let me translate that, folks, to a question for the great Jim Caron. Is our journey that we're heading for a bond bear market?
Well, I think that we're in it right now. I think that we are making an adjustment higher in yields, but I do think that it probably stops somewhere above 2%, like around 2.25%, for this year. And the reason I say that is that right now what we're seeing is that these rises in yields are now starting to have a negative feedback impact on credit spreads. Credit spreads are starting to widen right now. That's going to create more anxiety in the bond markets. That can also lead to lower equity prices. And effectively, what I'm really saying is that we start to get a tightening of financial conditions that has a negative feedback loop into economic activity. And we're already seeing global PMIs starting to roll over and some signs of some slowing. So all of this does have a stopping point, but it may not be right here. It may be a little higher in yield, a little above 2% before we get there in the 10-year.
Jim, the argument from a lot of credit investors is that spreads haven't widened so much to where they are, compared to where they were pre-pandemic. And frankly, a lot of companies have immunized their balance sheets. They've borrowed for such a long time that they don't need to borrow anytime soon. Is the signal from credit really all that concerning, given the fact that you have highly capitalized companies?
Yeah, well, look, I think that's a great point. I don't think that there's a credit default risk that's going to run through the markets. I think that GDP is still supposed to be pretty good this year. Earnings are decent as a result of that. So therefore, I don't think default risk is very, very high. However, there is an all-in yield component to credit. These are still bonds, after all. So when yields start to rise, we're already seeing the year-to-date returns in many of these indices. They're down. As these yields continue to rise, you start not to see the inflows that you saw in the past. You start to see people pulling away from the asset class. And that's why I see this as a natural adjustment higher in yield. It's not a default risk issue at the moment. So to your point, Lisa, yes, interest coverage costs are low. Corporations have better balance sheets. They have more cash. They've termed out their debt. All of these things are good. I think corporate America can handle higher yields. I don't think this is a default risk issue, but I do think it's an all-in total return issue when it comes to an adjustment higher in yields, and this can drive people away from the asset class for the time being.
Given the fact that you think that there's more to come, are you hiding out in a lot of cash right now?
So we do have higher levels of cash, and there are also other places that we can look at, right? So areas, for example, like bank loans. I know most things are fully valued these days, but here's an index that's trading still below par at 99. You get good yield per unit of duration. This is a sector that is a good place to hang out at this current point in the cycle as yields are rising. The other is that we start to look for deeper value. Where do we have higher real yields? Where are we in places where we're being compensated to take the risk? And in some of these places, it's short end, front dated, short end emerging markets, where many of these central banks are way ahead, late in the cycle of hiking interest rates. They have the highest real yields around the world, the highest yield per unit of credit rating. These are areas that we also think are opportunities. So I'm not just saying it's about defense. We can play a little bit of offense here too if we watch the valuations, and that's what I recommend, and that's what we're doing in our portfolios.
Hey, Jim, awesome, as always. Great to catch up. Jim Caron of Morgan Stanley Investment Management. Morgan Stanley on Thursday looking for 7.3% on CPI. Wow. That is your median estimate. TK, going into year-end, Goldman out with a call. They review their call on the German 10-year Bund. Year-end plus 50 basis points is what they're looking for now. Positive 50 basis points. And right now, TK, big move. We're back to positive 20 on the German 10-year.
Your point 21 would be 30.30 up. So everybody's moving here around There's just no question about it. John, I think it's time for the Surveillance Olympic report.
Oh, here we go.
We got to do it. Australia curling, they won by 1 millimeter. I mean, they went into extra ends.
Are you trying to reprise
They literally
your
got
imitation?
out, John, by 1 This was really a lot of
just wants
tension.
to do it again.
Mr. Hewitt, they're from Victoria near Melbourne.
Okay.
And they beat Canada, which is like, it's like beating
That's
Liverpool.
a legit country with actual snow, Tom.
Yeah, thank you. It's just really, really good. What's so important here, and I've done this.
Brilliant
I mean,
analysis.
You're sweeping, John. You're sweeping,
my
and the
analysis,
skip
Lisa.
starts yelling at you the way you yell at me.
Probably
And you're
invaluable.
sweeping, and once I burst into tears, I was so upset at how
Is
the
that
skip
what you
was
were
telling
watching
me what to
last
do.
night when you
Yeah, you go
called
like
me?
this.
Please don't do that
Just
again.
wants to do that again.
I don't know why you felt the urge, the need to do that. Take
really
a pass
don't.
on that. What's the Olympics coverage about?
That's your
Tom?
Olympic report.
Where'd you find it? Where'd you watch it?
Find it. I'm glued to it at home. I watch nothing. I watch the
Is it on
curling
Peacock?
channel. No, it's not on Peacock. It's NBC
not.
Curling.
NBC curling.
Yeah, you do that in
Yeah,
the
you
bathroom.
have a
Unchanged.
Labatt's. Come on, John, get with
On
it.
the S&P,
You get a case of
I've-
Labatt's
no,
and you
thank
watch
you.
curling.
Given how you've just portrayed curling, I'll take a hard pass. Futures unchanged on the Nasdaq from New York. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. A warning from President Biden. He says the controversial Nord Stream 2 pipeline between Russia and Germany would be stopped if Vladimir Putin orders an invasion of Ukraine. The president's comments came after a meeting with Germany's Chancellor Olaf Scholz. Russia has repeatedly denied it plans an invasion. In Canada, Prime Minister Justin Trudeau is blasting the protest by truckers that has now halted commercial traffic to the U.S. at the busiest border crossing. The drivers say they won't stop until all COVID health restrictions are lifted. Trudeau says the protesters are hobbling the economy and trying to undermine democracy. Hong Kong is ramping up restrictions as it fights an unprecedented coronavirus outbreak. The city is extending limits to private premises for the first time in an attempt to keep people from socializing. Multi-household gatherings will be limited to 2 families. Hong Kong's also expanding the list of venues included in its vaccine mandate. And Chinese state-backed funds intervened in the stock market today. That helped the benchmark index stage a strong recovery from what was the biggest intraday drop since August. Bloomberg's learned the move by state funds was intended to slow the pace of declines. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
From New York City. Here in London. In Sydney. In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
If Russia invades, that means tanks and troops crossing the border of Ukraine again. Then there will be no longer a Nord Stream 2. We will bring an end to it.
The president said it, the chancellor not quite. We'll get into that in a moment. From New York City with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures unchanged on the S&P, and the Nasdaq 100 down 4 points, negative just 0.03%. A lift on yield through the curve in the Treasury market, up 2 basis points to 193.77. Are higher yields a good thing? Just getting my teeth into this Goldman note from Sharon Bell and Peter Oppenheimer. We think that the dramatic shift in rates, especially in Europe, is a sign that the problems that plagued Europe in the last cycle, low nominal GDP, growth, disinflation, no earnings, Tom, they say they are finally diminishing, and that is good news.
Well, it's good news, and we'll have to see what Euro does. I'm using currency, John, as a litmus paper here. And in all, would you agree it really hasn't moved yet? Sterling, 135.50, Euro, 114.26. We await, don't we?
Had a bit of a bounce on Euro dollar, Tom. I'm with you, though, 114.26. Let's see how far the ECB and others are willing to push this.
On Washington, on the war of words, I read one of the articles very carefully this morning, and I have no idea what's happened in the last 24 hours. Joe Matthew here to translate. Bloomberg Washington correspondent, smart show sound on Bloomberg Radio, piercing interviews. If you do sound on tonight, Joe, on Nord Stream, what's the biggest mystery for you?
Well, I guess who actually said what? I mean, to think that we had such a carefully choreographed dance, which, by the way, seemed to play well for Biden and Schultz's respective audiences. We're still not sure exactly where the Germans stand on this. You've been through it before. Joe Biden, we will bring it to an end. A direct quote here when he was asked what happens with sanctions in the pipeline if Russia invades Ukraine. And of course, Russia says it is not planning that. But the line from Schultz, we are acting together. We are absolutely united, and we will not take different steps. He was pressed by reporters and even reminded by reporters that he refused to say the word Nord Stream 2 out loud. The question today, I guess, Tom, is does that matter? And exactly what were we looking for from the chancellor here? He didn't clear Nord Stream 2. This is obviously an operation, a pipeline that has a lot of money invested in it already. And if Joe Biden says it's not going to happen anymore, that's not just as easy as it might seem in a soundbite.
To our American audience, such as myself, let's get to first principles. Is Nord Stream 2 a German property? Is it a NATO property? Or does the U.S. have a piece of the actions? The answer is no.
That's correct. So here we are, and it's starting to get a bit confusing as that meeting takes place at the same time as Emmanuel Macron is meeting with Vladimir Putin. That meeting, by the way, seems to be not getting as much attention here as the Schultz meeting. It happened on the other side of the world, but may have brought more news. If you listen to what Emmanuel Macron said before he sat down for 6 hours with Vladimir Putin, he referred to the Finlandization of Ukraine as one of the models on the table. Now, if you actually know what that refers to, that means Ukraine is going to be in for some big changes here in its relationship with Russia. Forced neutrality, essentially, not what Zelensky wants to hear, who's meeting with Macron today, or what this White House wants to hear. It did not come up again, that reference to Finlandization in the news conference that followed their meeting. But this is what was talked about in that room, Tom.
Joe, for some reason, the narrative points to an easing in tensions between Ukraine and Russia following yesterday's negotiations and what we've been hearing for the past week or so. Is that accurate?
Well, I'll tell you what, in terms of easing tensions, no, I'm not sure that's true. There's been no escalation. And Emmanuel Macron and the French seem to celebrate that things didn't get worse. There was no deterioration in the meeting. But we're talking status quo here. If you listen to what Vladimir Putin said in the joint news conference following his meeting with the French president, he was pretty tough. He was calling out NATO. He was calling out Zelensky. He was accusing us of fanning the flames of war. And he also said that there'd be continued conversations. He liked some of the ideas that Macron had proposed. But it was not, after a 6-hour session, the sort of breakthrough kumbaya that many hoped for.
We've spent about 8 years talking about very nationalist policies and moving away from an international interventionist type of model and looking inward. Are we seeing a shift back to the old normal when it comes to international relations and intervention, when it comes to the U.S. and their willingness to intervene here?
Well, it's a good question. It seems to be kind of a parallel track for this White House. Joe Biden today is going straight back to domestic politics, where he's got a lot of issues on his own as well. Incidentally, he's going to be talking about steps to lower the cost of energy, even as he plies the German chancellor to kind of deal with this idea that it could hurt economically if Nord Stream were to go away or if broader sanctions were to be implemented. But look, this president also needs to usher through a funding mechanism to keep the government from shutting down in a couple of weeks. And you're going to hear that sort of 1-2 punch from Joe Biden indefinitely. He's got a crisis on the other side of the world. You could argue he has one here as well.
Where's this crisis with the left of his party, the Liberals, Mr. Sanders of Vermont and the rest?
Well, it's nowhere right now, Tom. Build Back Better is on the shelf. I don't know that the president has a lot to make them happy, with the exception of a couple of Federal Reserve nominees that progressives are happy about, and of course, this looming announcement on a Supreme Court justice. In the meantime, it's a little bit icy between the two.
Joe Matthew, as always, sir, thank you. This is the part where we have to pay our fees, Tom, and do the promo. Sound on Bloomberg Radio, weekdays at 5 p.m. Eastern. Catch Joe Matthew a little bit later. Joe, we'll catch up in the next hour, sir. Thank you. The NFIB here in the United States of America survey 1,500 employers. It's the small business survey, and here are the numbers. The lowest optimism index in 11 months. It falls. Various sub-indices here, various questions they answer, and let me pick up on this one. The net percentage of firms, Tom, anticipating higher selling prices rises to 61%. Owners raising average selling prices, the highest reading since 1974.
These are the tea leaves that are going to be, everyone's going to be gleaned, including NFIB, which is a legitimate series, John. It's actually very accountable. I'm going to go to what we heard from David Rosenberg yesterday on another one of my properties, and also what Tom Porcelli wrote about yesterday, which is what they are watching is goods inflation. And as you mentioned yesterday, John, not the level, but the rate of change of that percent. And if goods inflation comes down hard, Porcelli's not predicting that, but he's saying it could happen. And that would be a huge game changer within all the different things we're looking at.
Yeah, the experience as well, Tom, and Lisa, weigh in between small business and large business. Very different experiences sometimes working their way through this economy.
Yeah, if you're dealing with retention bonuses, if you're dealing with trying to increase the salaries of employees, because it's, yes, you're talking about goods, Tom, and people are expecting the prices of goods to go down, but the price of labor is going up so dramatically that a lot of companies are starting to really dig deep into their tools of retention methods. And I just wonder if these small businesses can do it as much as larger businesses with larger balance sheets.
Governor Bailey's doing his bit. He's telling everybody don't get a pay rise.
Oh, yeah,
don't ask for a big one. Don't ask for a big pay rise.
That was so effective.
He's still taking stick for that. Lisa Abramowitz, Tom Keene, Jonathan Ferro. This is where I get told off. Futures down a tenth. on the S&P, down a little more than a tenth on the Nasdaq. The voice in my ear sometimes, Lisa. Up 3 basis points on 10s, 194.32. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City this morning. Good morning on TV and radio. Here's the price action. Not much of it in the equity market. Unchanged on the S&P. Negative a little bit on the Nasdaq, down 0.1%. The Russell going nowhere. In the bond market, a lift again on 2s, on 10s, on 30s. Switch on the board and let's get to it. 2s, 10s, 30s look like this. Up 3 basis points on 10s to 194.32. On the year so far, up a little more than 40 basis points. Talk a lot about speed. Speed and levels. Well, the level 132 on a 2-year, the speed up 60 basis points, almost 60 basis points higher year to date, up 3 basis points on a session. Up more than 60 basis points year to date, the 10-year real yield. Wanted to pick up on that, TK, because I know both you and Lisa are gripped by this one. We've gone from negative more than 1%, Lisa, to negative 47 basis points, blink of an eye, just like that. So we've done levels, We've done speed. Let's talk about destination. How far can you push that before something breaks?
Well, right now, we're not seeing anything break. I mean, we can see that stability in the equity markets. You could say, arguably, that the non-profitable tech companies broke. You could say that pockets of the market are seeing some serious distress. But the interesting aspect is this actually is giving a green light to the Fed. That's what a lot of people are saying, because you are not seeing more material disruption, and because this has been about them withdrawing support. This has not been about inflation expectations that have actually been going down.
Any cracks in credit just starting to break out?
Yeah,
just a
sure,
little bit, just a little bit.
But you're not seeing material distress because these companies are not at risk of defaulting.
It's a big move, Tom, and a big move very quickly.
Big move that we see, and of course this has to do with global Wall Street and all that we monitor across finance. We do that off the Bloomberg terminal. I would say there's a little separation here between 2s, 10s, the spread dynamic, and what we're seeing in the real yield, and that will wait for the inflation report 2 days on. Now with a briefing on that, Francis Donald joins global chief economist, strategist at Manulife, with wonderful parsing of the American economy. Francis, I've been doing research. You're going to help me here with a Chanel classic handbag, the tweed and gold tone metal coral handbag. $8,600 was $5,000 something days ago. Are we all going to have prices go up, and are we all going to eat it and just accept this new inflation?
Well, we'll have to accept it because you're going to face higher prices probably for the next few months. You will probably see CPI continue to rise on the next 1 to 2 readings. But are we going to be happy about it? No. Consumers are already indicating across a breadth of surveys that they are not happy. And most importantly, we're talking about real versus nominal yields. We have to be so careful in the coming months to be looking at real versus nominal spending, because yes, consumers are putting money out of pocket, but they are getting less for more money. That is not a healthy consumer. It is not a happy consumer. And when you ask consumers, are you worried about jobs? No, not at all. Are you worried about real income growth? Yes. And this is the big difference between looking at credit card transactions and actually having a good pulse on whether this is a healthy, happy consumer.
Okay, well, what's the power here? Francis, away from the Chanel tweed and gold tone metal coral handbag at $8,600, is the marginal effect of a gallon of gas is one indicator, or it can be down aisle 3 at the grocery store. What's going to be the protest from the American public to 7% inflation?
Oh, we're already seeing it. It's become hugely political. It's infiltrated the Fed. The Fed completely understands that inflation is going to mollify into year end. But can they stand there and say they're going to do nothing when their public is facing massive inflation? And here's the kicker here is that remember that inflation is a change in measurement. As I've said before, CPI math, inflation math is not real life. The big problem for the American consumer is that even as economists like myself tell you, don't worry, CPI is going to go back to 2% by year end. You're not going to see a cost of living deceleration. We're not going negative. So this cost of living increase, it has been extraordinarily painful for the consumer. It's going to continue to be painful for the consumer. And no, wage growth is just not going to cut it.
Lisa, this is gospel to me that the econobabble of a 12-month trailing time series means nothing to the consumer.
Well, it means nothing to the consumer if they are seeing negative real wage growth or a lack of growth, and that seems to be what's happening. Given this backdrop, Francis, you only expect 2 to 3 Fed rate hikes this year because, as you say, they've straight up missed the window. What do you mean?
Well, they have a very narrow window here where the data will still be strong enough, that inflation number will still be scary enough that they can get a March rate hike in. But come the second quarter, we're going to start to see just a pretty sizable growth scare. And it's going to go globally. It's going to be PMIs decelerating quickly. That massive fiscal cliff that we don't talk about enough, the lagged impacts of China, they are not going to have a lot of maneuverability in the second and third quarter to hike interest rates. Remember, when the Fed hikes, it's usually into growth accelerations, not growth decelerations. That's their situation now.
Francis, there is a distinction here between the Fed trying not to disrupt markets and the Fed being too late and the market already seeing a deceleration as a result of that deteriorating consumer confidence. Which is it, and why is it important to make this distinction?
There are so many reasons the economy is going to slow into the first and second quarter of this year, but it's not just about the Fed. Global central banks are tightening. Over 100 tightening measures in the past year. This week alone, we have Banxico, Peru, RBI that are tightening and pulling liquidity from this system. So this is a central bank that, in my view, does need to normalize and will normalize. But instead of the concept of front-loaded 5 to 7 hikes this year that flattens the curve and ups recession risk, there is a very real opportunity for a slow and gradual increase in rates a couple times for several years. And if I'm right, that's actually a far more bullish outlook, even though it comes accompanied with a slower growth outlook, because it allows the cycle to be extended and the yield curve to steepen. I may be wrong, but if so, if you're going to have 5 to 7 hikes in your forecast, then you better be incorporating a pretty sizable slowdown into 2023.
So, Francis, how are you betting against all of the strategists, and there are a lot of them, who are saying 5 to 7 hikes this year?
Well, timing, of course, is an issue, and this is the really big challenge, is the Fed needs cover to pivot, and they're not going to get that until they start to see that decelerating momentum in the data. So that Fed pivot I'm expecting probably isn't going to come for a couple of months. We got to go through more of this volatility, more of this curve flattening until you get to that moment. You really have to have enough data telling you growth and inflation has materially declined.
Francis, I don't want to go month to month to you. It's rude of me to do that, but I will go quarter to quarter. What is your quarter to quarter guesstimate of top line CPI in America? Let's say we're modeling here at 6.5, 6.8%. Then what, quarter to quarter?
Oh, well, we're going to drop pretty quickly. So maybe by Q2 down to 5 to 4, and by year end I have just over 2% in there.
Why?
And it comes back to something. It comes back to goods. This is the thing. Again, CPI math is not real life. Are you and I going to feel it different? And is that Chanel bag going to drop? No. But goods deflation is a key component of the outlook. Now, at the same time, there's another part of this story that is absolutely important. And if I'm wrong, it's really here, and that's wages. Now, Lisa mentioned wages, but remember that wage growth is fairly isolated into certain demographics and certain sectors. In finance and insurance, for example, unfortunately for us, we haven't actually seen major wage growth in that area. Quits are also isolated into leisure and hospitality, and that's where we're seeing wage growth start to decline. So the American economy is incredibly dispersed at this moment. There's no one number that encapsulates the entire American experience. I've never in my career had to spend so much time industry by industry, sector by sector, trying to parcel out what is really moving that headline number. So as we go into the second half of the year, in order for the Fed to have that cover to pivot, they're going to have faith that there is no wage spiral. They're going to be watching inflation break-evens, which have been remarkably calm. And as the Fed talks about, can they actually move goods inflation or services inflation? Not really, but they can change inflation expectations, and those are stable.
Are you modeling off your inflation call then that the average hourly earnings shock we saw 2-3 days ago is going to come down as abruptly?
Oh, yes. And part of that is a compositional element of average hourly earnings. But no, I should qualify. We will probably see 4 to 5% wage increases for the next several months and into year end. But again, this is a short window where labor will have that power. And it really depends on what sector you are looking at. Leisure and hospitality, absolutely. But a whole variety of other sectors are not going to see that wage growth, particularly higher income Americans are not going to see that wage growth. And that's why we have to be careful about one number dictating the entire American experience. That's just not the case.
Francis, wonderful. As always, fantastic. Francis Donald there of Manulife Investment Management. This is an important end of the debate, one side of it. Rupert Harrison of BlackRock is a part of it. Matt Miller earlier this morning referenced this quote. I'll do it again if you missed it. Really feels like central bankers around the world are making a collective policy mistake, trying to use rapid rate rises to call inflation that is driven mainly by supply constraints, just as growth momentum is slowing. Tommy concludes by saying, how long before the inevitable reversal?
And to translate this, witness the Bank of England with 4 cents, they wanted to go up even faster, John, is what we heard there from an in-the-trenches market economist is essentially the same tone we heard from the monetary giant David Blanchflower of Dartmouth, which is this is going to move, this is going to change fast. It means it's going to be an eventful year, to say the least.
I have to say, even though we've priced in, say, 5 hikes this year, Lisa, there doesn't seem to be monster consensus over how this is going to turn out. at the other end.
Well, I was going to say, it's not like Fed officials are coming out and saying we're going to hike 5 times or 6 times. Some of them maybe are saying that's a possibility, but they say that they're data dependent. I think it's interesting. We were talking about the ECB, right, and how suddenly they're hugely hawkish. And somehow ECB President Christine Lagarde totally changed some of the freak out yesterday by saying that they're going to take a gradual approach and be data dependent. She said basically the same thing. It's sort of a Rorschach test that people can sort of choose their own adventure with.
This is essentially in the process dictated by the ECB right now. They need to unwind QE before they discuss rate hikes. They're going to recalibrate in March. But if you take a guide from the most hawkish member of the ECB Governing Council, we heard from Klaas Knot recently, he's talking about 25 basis points in Q4. 25 basis points again in spring, which is why some people are pushing back against how much we've priced in for the ECB Lisa this year.
There's a humility among economists and among central bankers. They don't know, and I think that perhaps is what is giving the markets free rein to say, well, maybe we do, and maybe it looks really bad.
Humbled by the data of the last 12 months. I think that's what's made them humble for sure. Humility on Wall Street. Really? Futures on the S&P.
Yeah, sure.
Unchanged. Euro
Staying
dollar,
home with kids will do that
negative a tenth, 114.26. Yields high by 3 basis points, 194.50 on 10s. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. A day after meeting with Russia's Vladimir Putin, France's President Emmanuel Macron heads to Ukraine to meet with that country's leader. Putin said that his discussions with Macron could form the basis for future common steps. He's also repeated his warning that Ukraine should not be allowed to join NATO. The U.S. is losing patience with China regarding trade commitments reached during the Trump administration. American officials say they haven't seen any real signs of Beijing making good on its agreements. China pledged to buy an extra $200 billion in U.S. agriculture, energy, and manufactured products through the end of 2021. A billionaire Peter Thiel is leaving the board of Facebook's parent Meta to pursue Donald Trump's agenda. Bloomberg's learned that Thiel will focus on backing Republican candidates for Senate to advance the former president's policies. Thiel has advised Facebook founder Mark Zuckerberg for almost 2 decades. And big changes reportedly are on the way for Peloton, the fitness company whose share price plunged after a slowdown in demand. According to the Wall Street Journal, Peloton co-founder John Foley will resign as CEO and become executive chair. He'll be replaced by the former CFO at Spotify and Netflix, Barry McCarthy. Meanwhile, 2,800 jobs will be cut. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
the Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I do think that there's room to move, and I think we are going to see over the next couple months that it's going to be okay to slowly back down on certain measures that we've been living with. 2022 is different than 2021, but it doesn't mean we're in 2019.
Joshua Schaufstein there, the Johns Hopkins Bloomberg School of Public Health Vice Dean, with Tom Keene and Lisa Brabitz. I'm Jonathan Ferro. Your equity market is negative 0.1% on the S&P, down 0.2 on the Nasdaq 100. Into the bond market, yields are higher through the curve, up 3 basis points on 10s to 194.68. The euro slightly negative, euro dollar 114.31. As we round out some speed dating on the international scene. A serious degree of diplomacy taking place, Tom, in Washington, D.C., in Moscow, Ukraine. Crude backing off now, Tom, down 1.7%, 89.77.
Our thanks to Angela Stent of Brookings and Georgetown for a piercing interview yesterday on all of that. She is definitive. Her book, Putin's World, is absolutely definitive. John, I want to point out the 10-year real yield. It vaults from a 0.48 negative statistic to negative 0.46 right now. It's not a vault, but I exaggerate, but nevertheless, a lesser negative yield in the real yield trend this morning. On the pandemic, on your confusion on masks, Amish Adalja joins us from Johns Hopkins Center for Health Security. Amish, Eric Ting of SF Gate out in San Francisco writes up how California mask mandates are now going to go county by county. Should we expect that nationwide, that there will be a city by city, county by county, block by block debate about indoor mask protocol?
I do think it's going to move from the state governor's mansions to each individual county or municipality making that decision on their own. And I think that's better than what we have now, because it's not one size fits all, and it might reflect the transmission that's going on in a given area. But eventually what you're going to see is masking become something that is an individual risk calculation. Some people will continue to wear masks, especially those who are immunosuppressed and are at high risk, and others will get rid of their mask. And it's also important to remember that one-way masking works. So if you're somebody who's very worried about getting COVID-19, maybe because you've had a kidney transplant, you can wear a mask one way, and it's going to provide benefit. But that's where we're going. I don't think that you're going to see many of these mask mandates at the state level stand for much long. And indeed, many states, including my own in Pennsylvania, have not had a mask mandate for months and months.
What is the science of masks? I've had this asked of me at least 3 times in the last 24 hours. If you're in a classroom, and you're definitive on this in Pittsburgh, if you're in a classroom with a bunch of interns and they say, what's the actual science of wearing a mask? What is it?
So the science is that properly fitting masks that are either surgical or procedure masks or N95 equivalents do provide 2 benefits. One is they provide source control. So if someone is infected with the virus, it's going to block some of that transmission from that person. And the wearer is going to get protection because those particles are not going to be able to penetrate those masks. And that most of that data is on medical grade masks, and most of that data is in adults that are wearing well-fitting masks. It becomes a little bit more fraught when you try to actually extrapolate that to real world use, because people don't necessarily wear masks the way they do in clinical trials. But there is data from the early days of the pandemic that places that did have high mask wearing did see cases fall, controlled for everything else. So there is data that it works, but they only work as well as you actually wear them. And you have to think about the context, what the marginal benefit is. Like, for example, wearing a mask outdoors is probably not going to have any benefit at all because the risk of transmission is already so low that you can't really get it much lower. Yeah. But they clearly work. But it's all about trading off the benefits of the mask versus the discomfort people have and how dangerous COVID-19 is.
Dr. Adalja, we're here talking about masks and mask mandates being lifted in the Western world. And even COVID-0 areas like Singapore and Australia have thrown in their towel and basically said, look, we can't pursue that strategy. We have to open up and just deal with a certain level of viruses. At the same time, Hong Kong is actually imposing even harsher curbs to try to stave off the infections that are actually spreading. Have we already seen this fail? Is this basically in real time the zero COVID policy in Hong Kong, in Beijing, failing?
Yeah, yes, and it was destined to fail because it's not an actual policy that's based on reality or based on the science of the virus. It's biologically implausible to eradicate or eliminate efficiently spreading respiratory virus that has an animal host. So COVID-0 was wrong from the beginning. If someone wrote that on an essay question on a test, I would say that's a wrong answer to how you deal with this type of a virus. And I wouldn't say that Australia and New Zealand threw in the towel. They shouldn't have even been holding any towel. They should not have even pursued that from the beginning because it was futile. I think what we have to come up with in these countries is a sustainable approach that knows that you're going to have COVID-19, but it's going to be milder because your population is vaccinated and you have monoclonal antibodies and Paxlovid. You teach the population what activities are risky or not risky, but China hasn't done that. And I think it's not surprising that an authoritarian country like China is the only one that's really still holding on to COVID-0. But what they're doing is just inevitably pushing off something that could be a disaster because they may not have enough immunity in their population because their vaccine may not be the best. They may not have had enough vaccine uptake, and they have no population immunity. So that's a really dangerous situation that China has created, basically kindling for COVID to really hit their country hard because they've been kind of postponing the inevitable and not actually taking the necessary steps to come up with a sustainable approach that reflects the biology of the virus.
Dr. Adalja, explain what the consequences of that are, because that's a very significant statement, this idea that you could be setting the petri dish for a mass uprise in the number of cases of COVID if they do open up their borders and they do have zero immunity or near zero immunity. What does that look like for the rest of the world?
From the rest of the world, as long as the world is vaccinated, it's not going to look bad from a health standpoint, but it's going to be much more disruption because China is a major trading partner, so supply chains, all of that will really be impacted if China is getting hit hard with COVID-19. You know, people always talk about natural immunity in a negative term, but the fact is the level of immunity in a population is important, whether it's vaccine induced or whether it's coming from vaccines, when it comes to how resilient your population is going to be, how much serious illness is going to occur. And because they have such low levels of immunity in the population, when you start seeing spread, inevitably, when they start to back off of those policies, if they don't have people vaccinated, you're going to see a lot of people get infected and a lot of people need hospitalization, and it's going to be very disruptive. And I think it will be something where people can look back and say, this is the result of what your policy was for so long. And that COVID-0 is actually put your population at higher risk, even though you might have been bragging and touting about the low number of deaths. It actually wasn't going to be that way forever.
Important final statement there, Doctor. Thank you. Dr. Amish Adalja of the Johns Hopkins Center for Health Security. The number one question we get asked, when's it over? My response, Lisa, how would you know?
And
how will you know if it's over, and what is it?
Well, it's not going to just end one day, and it is the restrictions that we've all been living with for a number of years. When we start to go to concerts, when we start to go to bars, when we start to go to restaurants, and you don't necessarily have to show your vaccine passport and you don't have to wear a mask, there is a feeling of some sort of normalcy, but it's already getting a little bit more normal. Look, honestly, what Dr. Adalja was just saying is really important, and this really goes into the whole supply chain disruption debate. Could it continue a lot longer than people think?
I have to take my passport to get into a cafe in New York City at the moment.
When that ends, when you don't have to bring your passport.
And I tell them it's like going through TSA. They take this long, hard look at it as well for about 10 seconds. Unreal. Tom Keene, Lisa Brabbits and Jonathan Ferro. Futures down 7 on the S&P. We're negative a little more than 0.1%. It yields up 3 basis points. 194.68 on 10s. Bit of a breakout here. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Fed is basically in the market right now.
Markets for the first time in quite some time are facing less liquidity and tightening economy overall.
The risks are that the Fed does have to move a bit more aggressively.
The flat curve is not ideal for the Fed.
but I think it's perhaps a better evil than a very steep curve.
We're in a rising rate environment everywhere.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Treasury yields heading higher from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market negative 0.1% on the S&P. TK10s at 195.
Yeah, yields on the move today. We're going to do equities here in a moment. This is going to be must listen and watch for all of you. But I'm going to look at the real yield, and I'm sorry, it's moving. And John, you mentioned the 2-year yield. We're on a 2% 10-year watch, aren't we?
We're at 132 on 2s, 195 on 10s. We started the year, Tom, ended 21 at about 150 on a 10-year, getting closer to 2. What gets your attention now, Tom? The level or just the speed of the move?
The rate of change. First and second derivatives here is all that matters. We're going to go all Newtonian this hour. John, what's so important is we had a big event on Friday. I got it wrong. We all got it wrong. And it proceeds into Tuesday. That's the headline this morning.
And then we got a big event on Thursday. Lisa, CPI just around the corner.
Yeah, the significance of this moment to me is that you normally have a market freak out, a market concern that percolates over, and then people have come in over the past couple of years. They've bought the dip, right? You are not seeing people come in and buy the dip when it comes to treasuries. And that is significant at a time when it's real yields that are increasing and not inflation expectations, which have actually been either staying constant or going down.
There's another difference here, too. It's not just the Fed that's about to hike interest rates. It's the ECB setting up to do the same thing, maybe at the back end of this year. But, Lisa, that's not what we experienced in the last cycle, the last tightening cycle. The ECB sat it out.
And that's the reason why people are looking at that pool of negative yielding bonds globally, which has gone down to the lowest level since 2015. How much does that change the entire dynamic of the global bond market when that's no longer the anchor?
And how much does it change the dynamic of this equity market too? Futures down 1/10 on the S&P. Good morning to you all on the NASDAQ, down 0.25%. Yields are breaking higher by 3 basis points to 194.86 on 10s. Yields a little bit higher through the rest of the curve as well on 2s, 132. Euro dollar down to 114.24, and crude is a break of 90 the other way, Lisa, down 1.5%, 89.97.
Yeah, let's see how long that lasts, because how much are tensions really easing. All right, let's whip you through some of what we're looking at today. 8:30 a.m. We get the U.S. December trade balance, which is poised to be the most significant deficit in data going back to 1991. Companies have been ordering a lot of goods. People slowed their purchases, and they've been stockpiling inventory to get ahead of any possible supply chain disruptions. At 1 p.m., we get the beginning of a slew of Treasury sales throughout the week, selling $50 billion of 3-year notes. Interesting to do this at a time when yields are the highest levels going back to before the first wave of the pandemic-related selling. And honestly, this week will be interesting. Tomorrow we get 10-year notes being sold, $37 billion of them, and the day after, $23 billion of 30-year notes. I'm curious about, John, whether that will actually be very well bid, whether people start to rotate back into longer duration because they start to expect some of these incredible numbers of rate hikes to translate into lower long-term growth. And aftermarket, Peloton is reporting earnings. This comes as there's a lot of speculation of a possible takeover that boosted the stocks mildly yesterday as we were talking about possible Amazon and Nike. And of course, we did get that transition with the CEO and the co-founder stepping down today.
Confirmed by the company just moments ago as well. Lisa, thank you very much. This is the most bearish Bob Dole, Tom, that I've ever heard.
Yeah.
I caught up with him a few weeks ago, and let me just say he was not that constructive on this equity market.
I think everybody knows I'm a huge fan of one Robert Dole. He's Chief Investment Officer at Crossmark Global Investments. But over the many decades, he's been a resilient bull. And then December happened. And Bob Dole in December said, wait a minute, this is a moment where the usual Bob Dole changes. The December Dole call was absolutely stunning. Bob Dole, are you back in the market after a 10% SPX correction?
Yeah, our target 4,500, Tom, and as we said a few minutes ago, who would have thunk we would have gotten it so fast? So I'm pretty neutral now. I think we're going to have a very volatile but trendless market. Earnings tailwinds, valuation headwinds. That's the big change. You guys have been talking about it. The Fed has made a hawkish pivot, and the market is slowly waking up to that, especially bonds.
Let's go CFA. Factor analysis right now, Bob Dole. What matters? Individual stock selection, sector selection? Is it about international sales? What matters in stock selection?
Yes, all the above. Look, I think you have to be positioned for companies that can produce the earnings and the cash flow and not expect valuation improvement. In fact, I think the opposite. That takes me more to value direction. I want to own financials in a rising rate environment. Energy on a pullback, I want to own that too, because the world's demand for oil is moving up and supply is somewhat curtailed.
So you're pretty much bearish in everything. I mean, yes, you've got pockets that you see value, but you pointed out that equities, even though they're outperforming bonds, should basically struggle to eke out a positive return for the year. What does that mean in terms of your advice to some of your clients? How do you arrange and deal with the fact that you might expect no returns at best this year?
So for sure, rebalance. If you've not rebalanced, your equity weighting because of the gains in the last few years is higher than your target. Bring it back to target at a minimum. That's the first thing to do. The second is to make sure your portfolio is not overly populated with these growth stocks that have done so well over the last few years until the last few months. You need to cut them back some. You have to sell out of them. And for goodness sakes, if you've been totally in the U.S., stand up, take a bow, and do a little dollar cost averaging outside the U.S. where economies are picking up.
All right, where in particular, Bob?
I think that Europe is probably not a bad place to be. I think the emerging markets still have a challenge with China's credit problems. So I would stay with developed markets.
Does that breakout in peripheral yields worry you at all, Bob, in Italy, in Greece and elsewhere?
I think it's a signal of exactly the theme, valuation headwinds. When the supply or the amount of bonds selling at negative interest rates dropped 70% in 6 weeks, that tells you there's a change afoot. We need to pay attention.
Bob, you've been around the block a few times. I just wonder, do you think these central banks can pull off what they're discussing all at the same time together?
Now you're onto it. That's a very good question. I mean, you're starting to hear at the periphery people talking about as they move interest rates up, as companies struggle with supply shortages, labor shortages, some cost pressures. Could we have a significant economic slowdown? I sure hope not. I don't think so, but we're going to debate that.
Bob Dole, I want to go to your Lehigh University. Every institution right now is having huge trouble trying to figure out asset allocation. Do you look at the whole march here away from basic common stock ownership as constructive as a diversifier, or should people get back on board the good old all-American stock market?
Look, I think stocks still have a long-term place in portfolios as the central piece of what you're doing. I think bonds are going to be challenged for some times as interest rates normalize. So if you can find alternatives that have bond-like returns, bond-like volatility, but absent the interest rate sensitivity, they're the kind of places you want to be.
Let me go all Jay Pulaski on you. John talks to Mr. Pulaski a lot. He's huge on Pacific Rim. Can you be large on Pacific Rim?
Yes, I think the Pacific Rim that serves still fast-growing, albeit slowing, China and India, they're still good places to be.
Jay needs the world to open up for that to work, Tom. What we're seeing in Hong Kong and China right now.
You're absolutely right, John.
That's going to be a problem, Bob, and I just wonder what your views are on that. We just caught up with Dr. Amish Adauja from Johns Hopkins, who was discussing the difficulty that China would have opening up. Need to see something happen with supply chains, don't we?
No question about it, and I heard that interview, and you're right. It's legitimate to be concerned. Those supply chains have to open up. I think a year from now we will solve a noticeable piece, but not of all of our supply chain problems, and that's part of the inflation problem. It's part of companies not being able to satisfy consumer demand. So we can solve a few of those. That's good news.
Bob, final question: what would make you bullish?
If you told me that interest rates don't have to go up, but I can't see how you can get there. We have valuation headwinds. When interest rates go up, PEs come down. A 22, 23 PE where we were just 2 months ago, not appropriate for an environment where the Fed's taking the punch bowl away.
Bob, it's fantastic to see you, sir, on a regular basis. I'm enjoying this. Bob Dole of Crossmark. Thank you, sir. Thank you, buddy. Let's play Wall Street Roulette. Pick a bank, Lisa. JP Morgan or B of A?
B of A.
B of A. Fed hiking into an overvalued market. The market is more expensive ahead of tightening than in prior periods, with the exception of 1999. I'll throw the counter from JP Morgan. We believe that equities still offer upside and that the cycle is far from over. The Fed is unlikely to keep moving further and further into hawkish territory, at least relative to what is priced in currently. they are two of the views and really the two main camps on Wall Street right now.
Right now, we're looking at whether you believe that inflation will continue to persist longer, whether the data that we got wrong last year will continue to surprise in terms of persistent inflation, versus a Fed that watches a slowdown in the data and pivots his response.
The weakness in the back half, Tom, that seems to be the concern of some.
The back half of what? The back half of February?
If you can get me out a single month, Tom, I'd pay some serious money for that.
I really have trouble with the back half quotes. Look, John, for those whose heads are spinning, and trust me, with great humility, my head is spinning. John, let's devolve this down to two guests with two different views, two different outlooks, both of them with massive academic cred. Think Dartmouth, and of course at the New York Fed and Berkeley, Bill Dudley. The divide of Blanchflower and Dudley, John,
massive,
defines every interview we do.
Never seen it bigger, Tom. Never seen it bigger. The previous cycle, Blanchflower didn't want to move. He didn't want to raise interest rates. But the numbers we're talking about, the destination in the mind of Bill Dudley, that rate has got to go a whole lot higher. What did he say about the dot plot, Tom? Called it fantasy land over at the Fed.
I'm not. I think people know I'm not a fan of the dot plot. What's interesting to me is take Steve Major, who's in with the Blanchflower crew, but he models out, okay, rates go up, and we heard that from Francis Donald, and then deep into February could be interesting.
Steve is often on top of the self-limiting aspect of a bond market sell-off. I believe he's still looking for 150 on 10s into next year. Brian Levitt joining us a little bit later from Invesco. Don't miss that. Futures down a tenth on the S&P. Euro dollar negative a tenth at 114.25, and yields higher by 3 basis points. Let's just round it up. 195 on 10s with Tom Keene, Lisa Abramowitz and Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. There's been a flurry of diplomacy prior to today's resumption of the Iran nuclear talks in Vienna, and it suggests that negotiators are trying to close in on a new agreement. A deal would likely allow Iran to resume exporting oil in exchange for limits on its nuclear program. In Canada, Prime Minister Justin Trudeau is blasting the protest by truckers that has now halted commercial traffic to the U.S. at the busiest border crossing. The drivers say they won't stop until all COVID health restrictions are lifted. Trudeau says the protesters are hobbling the economy and trying to undermine democracy. In the UK, consumers held back on spending last month. According to Barclaycard, the value of card purchases rose 7.4% in January. That's compared with the same month in 2020. That's the smallest increase since April. Barclaycard says 9 out of 10 adults are concerned about the impact of rising inflation on their finances. And Chinese state-backed funds intervened in the stock market today. That helped the benchmark index stage a strong recovery from the biggest intraday drop going back to August. Bloomberg's learned the move by state funds was intended to slow the pace of declines. And big changes are on the way at Peloton, the fitness company whose share price plunged after a slowdown in demand. Peloton co-founder John Foley is stepping down as CEO and becoming executive chair. He'll be replaced by the former CFO at Spotify and Netflix, Barry McCarthy. Meanwhile, Peloton also announced what it calls a meaningful reduction of its workforce. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
this chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Season continues.
This is record revenue.
Not since the 1980s have we seen these sorts of reversals.
Strong earnings put investors' Fed fears behind them for now.
Bloomberg breaks the numbers first.
A big beat for Apple. Caterpillar earnings.
Got McDonald's earnings.
An expert analysis you won't get anywhere else.
The fundamental story is really solid.
The supply chain shortage is still very much real.
It's really kind of a balancing act.
You run the risk of not holding the stock that makes its peers obsolete.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We've listened to Russia's concerns and shared concerns of our own about the steps that they're taking to undermine security. The United States, the European Union, our NATO allies, our OSCE partners throughout Europe have put forward ideas about how we and Russia can find common agreement that will strengthen collective security for everyone.
That was Antony Blinken, the U.S. Secretary of State, with Tom Keene and Lisa Bramwitz. I'm Jonathan Ferro. Futures negative 0.25% on the S&P. On the Nasdaq Dow 69, we're negative 0.5%, with Treasury yields delivering a little bit of a lift here, up 2 or 3 basis points to 194 on 10s through 130 again on 2s. In the commodity market, we're down 2% on crude to 89.51. Stock of the morning, it's Peloton. It looks a little something like this. In the pre-market, in early trading, we trade lower. We're down by 8% after a monster rally yesterday. A rejig at the company. 20% of corporate positions will be gone. 2,800 global jobs will be cut. A rejig at the top of the company as well. A win for Blackwell's Capital, the activist investor. John Foley stepping down. He'll become executive chair. Barry McCarthy stepping up, the former CFO at Spotify. The question, Tom, now is whether Barry McCarthy wants a dance partner or whether he wants to fly solo. I think that's the question for the stock. Are they open to a takeover or not?
What he's going to say is he needs to get the financial ratios in order with a new regime of lower revenue. I'll talk about Barry here in a moment, John. This morning when I came in, John, that was about 5... I think at 5:52 is when I walked in the door. The first thing I looked at was the CapEx on Peloton, down 150 billion. This is a million rather. It's a tiny company, million. This is about a 35% haircut off of modeled fiscal year 22 CapEx. That's a big, big cut. I mean, John, they're really cutting in here.
You think they're cleaning up for a sale?
I think they're cleaning up as a first-order condition. Barry McCarthy is grizzled. He's at Spotify, yeah, but far more at Netflix. This guy's out of Williams College, and he's got a huge track record, John, of action. He's a let's go guy.
How do you know everybody's academic background?
Because in America, John, people really care about that.
They're defined by the school they went to 40 years ago.
Yeah, particularly into March Madness. No, you really want to know?
Wikipedia.
Okay, McCarthy's got one of the coolest degrees in the nation. He had the privilege of studying with James McGregor Burns and Ross Bostard, it is, at Williams College. John, there's no other history degree. If you get to study with James McGregor Burns at Williams College, you can't do better.
Why do you know this?
Because this is what I live, John.
I know.
I studied with Egon Stark I studied with Egon Stark on Pseudomonas orangina. I can't remember, anaerobic bacteria.
Orangina.
Orangina is like
the thing that throws me about you every single time.
Oranginosa.
I have immense respect for how intelligent you are. You know things that I would never dream of even thinking about learning. But when you say things like orangina, I sit there
Oranginosa, Pseudomonas
that was something I
oranginosa.
used to drink when I was a kid.
Yeah, ask Amish Adalja about Pseudomonas oranginosa.
I'll ask him off the record another time. Carry on. Stock's down 8%.
Are we done?
We're done.
Coming up, folks, Australian curling. Joe Matthew joins to save the hour, Bloomberg Washington correspondent as well. Joe, we've been talking about the linkage here of economics into politics, a great conversation on the pandemic as well. What's the to-do list for the people assisting the president? What's the mandate for February and to get to March?
Boy, just watch those numbers go down is the hope. If we're talking COVID here, Tom, although it's kind of interesting to see the headlines from yesterday, from the view of the White House, and Jen Psaki was asked about this in the White House briefing, what is going on in New Jersey? What's going on in Connecticut and Delaware, where Democratic governors are saying, you know what, with the mask mandate, let's go back to the local authorities on this one. This is in the case of schools for New Jersey, and the case for the indoor mask mandate in the other states. This may not be the White House's issue as we go into the spring. If this is going to devolve to the state and then even more local level, where does that leave Joe Biden? It's a question that we're asking this morning following this news this week.
Well, Joe, what this comes down to, and let's bring it parochial here. We can do that with John Farrell. I mean, John doesn't understand the bean pot. You're going to go to the bean pot at Boston Garden, and am I right? No one's wearing a mask, basically?
Well, yeah, you can go up to the U.S. Capitol and see people not wearing a lot of masks as well. It just depends on what community you're in what crowd you're in. We saw the new governor of Virginia just across the river in Alexandria this week at a grocery store, no mask. A woman from the next aisle over said, hey, read the room, buddy. You're in Alexandria. This is going to become a hyper-local issue, reminding everyone that last evening as I was heading home from the broadcast here in the D.C. Bureau, the National Cathedral was tolling bells to mark 900,000 dead. It was just the middle of December. They were doing the same for 800,000. How quickly this variant will burn out and what we're left with that in the spring is going to answer a lot of these questions.
Joe, in the meantime, are they getting anything done when it comes to legislative agendas on the Washington, D.C., considering the fact that evidently we're facing another funding gap?
It's a great question. On most any day. The good news is, Lisa, we're not talking about a government shutdown. That in itself is news. The government runs out of money, so to speak, on February 18th. There's going to be a continuing resolution because they need more time. They need another 3 weeks or so to hammer out these 12 appropriations bills, but it looks like it's actually going to happen for the first time since October. We'll have a full year budget in Washington. That shouldn't be a news headline, but this year it is.
Joe Matthew, thank you, sir, down in D.C. Don't miss Sound On Bloomberg Radio, weekdays at 5 p.m. Eastern.
That was great. John.
Joe Matthew. That's the one thing in prompt for the whole show, Tom.
Exactly. That's how scripted we are. John, this is important, though. BU Northeastern in the Beanpot. It's a derby, John. I mean, it's like a Boston derby. It's a big deal.
Isn't Boston known as Beantown? Isn't that right, Tom?
Very good.
Why is that? Where does that come from?
I think I knew once. I don't remember why.
Okay.
I don't
Maybe
remember.
you can look that up for us.
BU and Northeastern, they beat Harvard and BC, and this is good. This is a great and beautiful February. It's like Groundhog Day, but better.
Right. Lisa's got an answer.
Yeah, it refers to the regional dish of Boston baked beans.
Boston baked beans.
Nailed it.
There you go.
Do they do them on toast or just separate?
John,
I think they do it separate. It's
the way
toasted, but I am not a Boston
John,
expert.
the way the waitresses talk to you at Durgan Park, you would have loved it.
Why is that, Tom?
Oh, they're like,
Do you want to elaborate?
Every meal is a bit of a domestic.
Usually when I talk, I have to repeat myself because they don't understand the accent. I'm not sure how this career's worked out stateside, but it has so far.
It's just glowing.
Just working perfectly. Down 1/4% on the S&P. On the NASDAQ, we're down about 1/2%. The NASDAQ just breaking down a little bit, Tom, as yields break out on 10s.
10-year real yield. I'm sorry. There it is. It's moving.
And nominal yields too, Lisa. 132 on 2s.
Yeah, the idea that we're really looking at not necessarily the inflation expectations, but the real yields driving yields higher.
What happens if CPI surprises to the downside on on Thursday. What do you think that looks like?
Complete narrative shift.
Six handle?
Narrative shift.
Narrative shift on a six handle.
Yeah,
They
transitory.
were such a good band. I love Narrative
Really?
Shift. They were so,
Who did they open for, Tom?
well, I can't remember. It was after Aerosmith.
Beantown Babies.
From New York City, for our audience worldwide on radio and TV, this is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City for our audience worldwide on TV and radio, here's the price action in the equity market, breaking down just a little bit, down 0.2% on the S&P, on the Nasdaq down by 0.4% as yields break out. So let's go straight into the bond market, 2s, 10s and 30s, and talk about what our guests have been talking about. Goldman, BNP, speed and levels. Levels right now, twos look like this, up 3 basis points to about 132, the highest since early 2020. Tens at 195, the highest since the summer of 2019. And the speed, you know it and you know it well now. Twos up by almost 60 basis points year to date, on tens up around about 40. So we've done speed and levels. Let's do synchronization and destination. Switch up the board and get to this. Year to date, synchronization, it's synchronized this time. It's not just the Fed. It's not just the BOE. The ECB might join the rate hiking party. And this is what we look like on twos in the US, the UK, and Germany. That adjustment year to date, Tom, gets my attention, Lisa's attention, and your attention too.
It's a transatlantic move, and I can't even remember how we did this in the last section. We're having so much fun here. But John, I think it's really, really important. What if we get an inflation surprise?
A downside
Thursday?
surprise.
What's it mean for BOE and the 4 dissenters?
We'll find out, Tom, on Thursday. If we did get a downside surprise, Lisa, I'd imagine you recalibrate. Can you recalibrate that much off one data point? That takes me some synchronization to destination. The destination piece of this, the debate is wide, wide open. How far can these central banks take it? The Fed, the Bank of England, and the ECB too.
If you ask everybody, they're going to say one data point doesn't matter, but then that data point comes out, and all of a sudden it matters quite a bit. And I would suspect, given the lack of conviction in markets on that destination, you might get a pretty big recalibration.
It's like payrolls on Friday. It did not matter until it came out and it was good, and then all of a sudden, apparently, it really mattered. That's your cross-asset price action. Let's get you some single names, some movers, and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. One of the biggest volume movers out there is Peloton. We were expecting those earnings after the bell tonight. They came early here. Of course, all the speculation about John Foley. John Foley is out. That's confirmed by the company. Barry McCarthy, the former CFO over at Spotify and Netflix, he's in. It'll be interesting to see what the strategy he takes with this company, whether this is going to be a standalone company or whether McCarthy sort of, I guess, goes back to his roots and maybe potentially positions this company for a potential buyout by some company or another here. The shares are down by about 7%. The numbers themselves almost immaterial at this point. You did see that decline in hardware sales, worse than expected. You also saw a decline in the number of subscribers. That was worse than expected. The upside and the reason why this is an acquisition play is that subscription revenue. It is on fire. It was up about 73% year over year, and that shows that at least with the core audience, the core customers it has, Tom, this is still a business.
I think we got to sit on this, Romain. I know you're going to do it to close, but Farrell and I are all over this. Are we actually going to see McCarthy set this puppy up for a takeout?
That's a speculation. I mean, look at his history, at least most recently. He's gone from a lot of companies. A lot of people know him, obviously, from Spotify, Netflix. But remember, he was at Klinkle. He was at a couple of other Silicon Valley startups. His whole MO was basically to get these companies into financial shape. He is an accountant. Yep. He is a finance guy at heart. Get these companies in financial shape and get them out to the market. Obviously, Spotify was his biggest success with that direct listing. So, yeah, I mean, he didn't say what he's going to do. That was not in the press release. But I think the speculation is certainly warranted going forward, Tom. And, and just keep an eye on a few other names if you're interested, Tom. Pfizer also out with earnings. NVIDIA, of course, that ARM deal finally sort of being put to rest here. A lot more we're going to have, Tom, later tonight after the close.
The close this afternoon with Romain Bostic as well. Right now, and this is a joy, Kathy Jones joins as Chief Fixed Income Strategist at Charles Schwab. John and Lisa got some 60,000-foot questions. Kathy, I want to go to the Schwab retail investor. I have a vanilla total fund. It's got sovereign credit in it. It's a blended portfolio. Forget about the yield. On a price basis, it's down 5%. Annualized, it's down 12%. For retail, that feels like a bond bear market to me. Are we on the cusp of a bond bear market?
Well, I'd say we're in sort of a mini bond bear market already, because, as you say, it's very unusual to get drawdowns in excess of 2 or 3% in the bond market, kind of writ large. So when you're down 5%, it certainly probably qualifies as a bond bear market. Now, we're not in the camp that says this is kind of regime change and we're going into a 10-year bond bear market, or even perhaps a 1-year bond bear market. But we've certainly seen a significant decline now, as you would expect when you start to see rates move the way they have.
Lisa, under CFA level 2, a bond bear market is defined by when you open your monthly statement 3 months in a row in itself, that's a bond bear market.
Right, and the question is whether that's a self-fulfilling prophecy, whether people see the red and they withdraw more cash, or whether some people say, you know what, we want to hide out in some of these securities, especially if we are concerned about the consequence of rate hikes. And Kathy, that has been part of your thesis. How much are you continuing to double down on that duration call?
Yeah, we've had a short duration call for, really a long time, probably a couple of years now. We're actually starting to advocate taking on a bit more duration as yields move up. So one of the things we see is you get into a rate hike cycle, the yield curve flattens, you get 2s, 10s below about 50 basis points, and you're probably pretty near the peak in 10 years. So as we get into the rate hike cycle and we see that yield curve flattening, we're actually advocating starting to take on a little bit more duration, not jump into 30-year bonds here, but to start to add to that duration, because there's nearly, the market's gone a long way already to build in this rate hiking cycle. We're already seeing financial conditions start to tighten a little bit, so we're on the verge of probably hitting at least an interim peak.
All right, in an interim peak, but can you sit on that for just a minute? We have that 10-year yield now at the highest levels going back to late 2019, 1.94%. This is a near-term peak, an interim peak, but do you think that this is the peak of the cycle?
Probably for this cycle, if the Fed and the other central banks follow through on what they're saying they're going to do. So we think this cycle is pretty powerful because it's globally synchronized. The Fed is using both quantitative tightening and rate hikes to bring down inflation and to slow the economy. Fiscal stimulus is already a thing of the past and will fade. So as we look out over the next year or so, which is probably defined as the cycle here, we think that we're probably fairly close to the peak in longer term yields.
Kathy, you point to some data, economic data, showing that actually you are starting to see a slowdown in the pace of the economy. Can you give us a sense of the slowdown in the economy versus the slowdown in inflation and whether it makes a difference for the two?
Sure. So typically some of the signals that we watch are like the global PMIs. They're starting to roll over. We're seeing personal consumption expenditures start to ease up, which isn't too surprising because the fiscal policy boost we got is waning. And those are indicators that usually precede the peak in inflation. So we all know inflation's a lagging indicator. And so there's also the problem that as oil prices move up and gasoline prices move up, it erodes consumer spending power. So our thesis is that we're getting into a slowing economy as the year plays out, and as a lagging indicator, inflation will come down as a result.
It's nonlinear. When we come from 7%, Kathy Jones, down on inflation, as is widely presumed, what's the single point trip point for psychology? Under 4%?
I would think so, although I will point out that certainly the market-based expectations for inflation haven't really moved up that much. On the retail side, or when we look at, say, the University of Michigan Consumer Sentiment Survey, those have become more elevated, although really the long-term outlook isn't for much more than 3%. But I'd say the trip point in terms of psychology in the market, if I had to name it, would be gasoline prices. People are very sensitive to what it costs to fill up the tank every week or whatever. I don't know. I don't drive, so it's not an issue for me. But people are very sensitive to gasoline prices and, of course, food prices. So if we start to see those gasoline prices come down later in the year, I think that will change some of the inflation fears.
Lisa's the only one that drives around here, Kathy.
And the irony is,
the only one.
I grew up in New York City, so I relate to that statement, and yet I did get my driver's
I know, but you're so rich now, you drive out to go skiing on the weekend, and Tom and I don't get to do that.
No,
so Lisa goes skiing every weekend now.
Hold on a second. I learned how to drive, just to be very clear, because I went to Fargo, North Dakota, and I got my license after begging the person on the 5th time.
You begged the person for your
let's
license.
Not get into
do you want to disclose
No,
that?
I don't. I don't want to, but I do. I do. No, let's not. Thank you.
Quickly move on. Kathy Jones of Charles Schwab. Kathy, thank you very much. Picture this: you're a European bank trying to compete for talent, and then the regulator says, "We've got other ideas." The reporting this morning, led by Marion Halftermeyer out of Switzerland, Tom, on this one. Credit Suisse is cutting its 21 bonus pool by about 10% after Swiss regulators pushed back on higher pay following the bank's worst year since the financial crisis. This, according, Tom, to people with knowledge of the matter.
I saw the headline, John, and it really gives me pause. We've got another great bonus article out today, which alludes to how narrow these mega bonuses are. I take real issue when we say everybody at Credit Suisse is getting a mega bonus. Everybody at Goldman Sachs getting a mega bonus. It's a narrow group, and the tone is it's a one-off. So if they're in Switzerland and the regulators aren't going to let them get their one off, what's the why of working?
And what's the what next, Tom?
Yeah.
Because if they can't get paid, they can get paid somewhere else. We know that.
Exactly.
We know that, Lisa, from the likes of JP Morgan at Goldman Sachs over the last quarter.
Yeah, what you're going to see is a huge question as to what talent's going to remain and whether they just bifurcate the pool, not to get specific, and give a lot to their top performers and basically push away the people who are not. And how they deal with this is going to be tough in this environment.
Isn't that usually how it works anyway? You're just saying that'll be accentuated just that little bit more?
Yeah, I mean, honestly, either it's that or they risk losing their talent. I mean, this is a pretty tricky negotiation considering what we've heard from the other banks.
Credit Suisse have had a tough time. Tom, a few years ago, it was Deutsche Bank. Every time we'd get a story like this, it'd be Deutsche Bank. And now seemingly every single time it's Credit Suisse.
They've been challenged, to say the least.
In a big
it's
way.
a unique Zurich thing, John, that you and I have experienced.
Very much so. Coming up, Congressman French Hill, Republican from Arkansas, who knows a little bit of something about financial markets and regulation. We'll get to that in just a moment. Futures down 10. Let's call it down 9. We're down 0.2%, and yields at 194 on 10s, higher by a couple of basis points. With Tom Keene, Lisa Abramowitz, and Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. A day after meeting with Russia's Vladimir Putin, France's President Emmanuel Macron heads to Ukraine to meet with that country's leader. Putin said that his discussions with Macron could form the basis for future common steps. He also repeated his warning that Ukraine should not be allowed to join NATO. The U.S. is losing patience with China regarding trade commitments reached during the Trump administration. American officials say they haven't seen any real signs of Beijing making good on its commitments. China pledged to buy an extra $200 billion in U.S. agriculture, energy, and manufactured products through the end of 2021. Billionaire Peter Thiel is leaving the board of Facebook's parent Meta to pursue Donald Trump's agenda. Bloomberg's learned that Thiel will focus on backing Republican candidates for Senate who advance the former president's policies. Thiel has advised Facebook founder Mark Zuckerberg for almost 2 decades. A divided U.S. Supreme Court has dealt a blow to minority voting rights. It reinstated an Alabama congressional map that creates only one district likely to elect a black representative. A lower court had said federal law required a second one. The High Court's ruling ensures that Alabama voters will use the original Republican-drawn map in the November election. The state is 27% black. BP boosted share buybacks after surging oil and gas prices lifted profit to the highest in almost a decade. The British energy company will repurchase another $1.5 billion of shares using surplus cash flow from last year. BP also pledged to accelerate the transition to cleaner energy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project. Initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
A lot of uncertainty. But what I will say is that demand is strong, and you can easily see a further tightening market throughout this year. But more than anything, I think we should expect some volatility, and at the end of the day, we don't know what the price of oil is going to be.
Who does? Bernard Looney there, the CEO of BP from New York City with Tom Keene. Lisa Abramowitz and Jonathan Ferro. Your equity market down 0.2% on the S&P, down 0.4 on the Nasdaq 100. Crude pulling back too. We're down by a little more than 2% on Brent, 90.73. WTI a break of 90 to the downside, 89.62, down by 1.9%. And yields higher, Tom. That seems to be the story this morning in the Treasury market, up a couple of basis points, just short of 195 at 194.32.
Let's get to Peloton right now. We're going to do it the surveillance rate. Critty Group to get us started with a smart chart. Critty, what do you have?
Yeah, we just got to look at Peloton shares. We're keeping it simple today, Tom. We're just looking at it from its debut going back to September of 2019. If you actually look at how this chart looks, it looks pretty similar to other kind of pandemic proxy stocks. Zoom, for example, Netflix, they have that same shape, essentially a round trip for our radio audience. Another thing to keep in mind here, you see this massive acceleration in 2020 and then a pairing of those gains in 2021. For Peloton, it is now back at levels it was at during its IPO back about a little over 2 years ago. So it really tells you here that Peloton not only has it been having its own issues in terms of keeping its subscriber base and growing its subscriber base in the light of this massive reopening, but its stock has quite literally been a round trip.
Very good. Critty Group, thank you so much. With a little bit of visualization there. Much more on this, including at the close this afternoon. Right now, and this is what we like to do best, is take great pride in saying, okay, sell side, who got it right? As we talked to Bob Dawley earlier about a great December call on the stock market. Simeon Siegel is senior analyst at BMO Capital Markets, and in April of the first pandemic, stuck his head out as a Peloton user and said, it's not going to work. The drama is it was a sell. Maybe he said underperform. I'll say sell. Simeon, what did you see in April of 2020 as you actually sat using a Peloton?
Yeah, I like that throw in. I mean, I definitely was on the seat. So I think the reality is what we watched was a product that people loved, that people extrapolated to go much further. And I think the question to us was the pandemic going to be a pull forward of demand or an expansion of it? it seemed like this was going to be a pull forward. And the data kept arguing that way. And that was the most interesting part, because what we saw was a meaningful deviation between the numbers and the stock price. And that was effectively why we stayed there.
Barry McCarthy is going to have to talk to you about how you got out front on that. Forget about the mathiness, the CFA chat. I want you to talk about the universe and potential universe Mr. McCarthy will have to grow unit revenue. Is it there?
So my team has done a lot of work on connected fitness. We have an 80-page primer out there on connected fitness. I'm a huge proponent of this sector being in its infancy. I think there's a tremendous opportunity. I think what we saw was a conversation around inventory management and brand protection. And listen, you and I know when brands don't have competition and their audience is trapped at home, they don't have to market, they don't have to promote. It's easier. When all of a sudden there is competition, I can tell you there's a tremendous amount of up-and-coming, really exciting, innovative competition. You need to market, you need to promote. It's just a different conversation. So I think Barry can look at this and say there's a phenomenal brand. Peloton has built one of the best brands known to humanity. And I say that hyperbolically, but also that's why the stock did what it did. So I think what we need to do, or what they need to do, is effectively they're making the right decisions now. Focus on health, focus on recalibrating the business. But then as you're going forward, that does have an impact on growth. And what you can't do is try to reset, cost cut as you're growing at the same time. You need to take this Band-Aid, rip it off, focus on what needs to be done. And I think what's really sad about that, and what we need to remember, is there's a human element here. A lot of this cost cut is going to fall on people, and that's this reality. But I think that's where we go from here. Once they have refigured out who they need to be, then they can start focusing again on the TAM, because what we need to acknowledge is they still have 2.77 million subscribers. That's a really nice number considering what they did from the startup stage.
Considering that that is a pretty big number, and this actually is not just in terms of subscribers, but also data, does it make sense for any company to really buy it?
Yeah, I think the acquisition conversation is really interesting, because what didn't happen was a very large company didn't buy Peloton when they were on their up and up. And I think that the notion of they want to buy something that's now a fixer-upper seems to have a lot more questions than answers. So at the end of the day, and I haven't done empirical data, I haven't done this survey, but I think we'd all assume that Peloton subscribers probably already Prime subscribers, right? That overlap is probably pretty meaningful. So what does it add is going to be a big question. And this notion of right now we're seeing demand and engagement falter, is that what these companies do? Is Peloton simply too small right now to matter to the largest companies in the world? I think is a very important conversation. And that data, right? I've been talking to people, and you think about like other companies. Apple was conspicuously absent and not meant as a prop, but here's a watch. I mean, that Apple has a lot of people that are riding their bike already connected anyway. So I think we do have to ask that question of, is Peloton better as a standalone, compelling brand with a more insulated group, which, by the way, means pricing power? Should Peloton be raising price rather than cutting price? I think that's the question to be asked, rather than do they fit really well into a much larger business that probably already has access to data.
So, Simeon, this is an important point. What would make you bullish on this company without the idea of it selling itself? Is it price increases? Is it something structurally in terms of strategy?
Yes, listen, I want to be intellectual. I would love to get bullish on this company. I think it's a great product. I think that right now what I need is this. You need to know that the management team is aligned with the future possibilities of the business, and you need to know that they know what they should be when they grow up effectively. We upgraded at a similar time when we downgraded Peloton. We actually upgraded L Brands, which owned Victoria's Secret, which sounds drastically different, but is oddly enough becoming very similar. Here's a brand that people said was dead, was completely over their skis, but they sold $5 billion worth of products. They had $5 billion of revenue, selling cloth, not making money. What were they doing? They were under-earning because they were overselling. Price elasticity of demand. You go back to college and econ, and you just think about supply-demand economics. What Victoria's Secret did was they decided to sell less and charge more. Their sales plummeted, their EBIT dollars skyrocketed, and L Brands became one of the best, if not the best, S&P stocks that year. So that's, I think, what we need to do. And if we can get aligned with the fact that that's what's going to happen, then it gets more compelling. Then you and I have to ask about the stock price, because the reality is value restructuring stories don't trade on sales multiples.
Simeon, we're thrilled to have you here in real time, and I don't want to front run your clientele at BMO Capital Markets, but the bottom line is today a regime shift where you can adjust from your stunning underperform to something different without giving away the secrets?
So listen, rather than it's not even an issue of front running my clients. It would be a much bigger issue than that. But that's not what I'm going to do. So if I think about what we did last week, we published a deep dive. We spent a lot of time publishing a deep dive that basically got to the peak of an $800 million. We had $820 million at the peak of expense savings that were going to cost potentially $125 million of cash charges. We just got something very similar to that. the question of what happens next, right? Because that's not actually kitchen sinking it. Suggesting you're going to save a lot of money is the opposite of a kitchen sinking. What we need to know right now, the question, and right now the conference call is going to happen soon. So there's a lot of questions to answer, but we need to understand, where does a company want to go from here? And with the information we have right now, we have an underperform on the stock.
Simeon, thank you. Just brilliant. Thank you very much. Simeon Siegel there.